I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief. Stock futures edging higher this morning after a milestone market for a moment for the Dow. We've got Dow futures holding steady on the heels of touching 40,000 for the first time. And it looks like, at least right now, Brad, we're set to open above that level.
Yeah, I put in my request for a hat with some of the traders down at the NYSE. We'll see if I get one. Remains to be seen. And GameStop shares, we're tracking those this morning on the company's preliminary Q1 results. The news sparking another sell-off in meme stocks this week. Let's get to it with the three things that you need to know. This Friday morning, we've got your roadmap for the trading day. Yahoo Finance's Josh Schaefer, Josh Lipton, and Madison Mills have more.
Hey Brad, stock futures taking a breather this Friday morning. Softer inflation data pushing major averages to record highs earlier this week, with the Dow surpassing 40,000 and the S&P 500 trading above 5,300 for the first time ever. Indexes are on track to end this week with gains.
And GameStop shares are under pressure here this morning. The video game retailer issuing its preliminary Q1 earnings, revealing that GameStop expects a decline in sales. The company also said in a separate filing it plans to sell its securities for an unspecified size. Shares down, you can see, about 20%.
And shares of Reddit surging to the upside this morning after announcing a new content partnership with OpenAI. Under that agreement, OpenAI will gain access to Reddit's data. That'll allow the social network to bring new AI-powered features to its users. Those shares popping this morning, up over 10% in the pre-market.
Happy Friday, everyone. Our top story of the day, the Dow hitting 40,000 for the first time ever Thursday. But what components have driven the move? Yahoo Finance's Josh Schaefer has the full breakdown here for us. Josh.
All right, Brad, we're going to take it back a bit here. The Dow first hit 20,000 back in 2017, and several companies have contributed to the index doubling since then. Apple alone has accounted for over 3,000 of the Dow's 20,000 point jump since 2017, and United Health comes in a close second at just under 3,000. That's according to data from Bloomberg. But when it comes to the index's rally this year, United Health hasn't been much help, falling just about 1%. Investors really have two names to thank this year, Goldman Sachs and Caterpillar, both companies seeing about a 20% jump in 2024. And all of this comes into play when we look at how the Dow is weighted. United Health takes the top spot, making up over 8%, followed by Goldman Sachs, Microsoft, and Caterpillar, respectively. That's according to data from Index ARB. Goldman Sachs and Caterpillar alone have added almost 880 points to the Dow's rally this year as of the end of trading on Thursday, making them the two largest gainers so far this year. The next closest contributor has been American Express, which has added more than 350 points in 2024.
Yeah, Josh, I think the question, and Brad, we have spoken about this time and time again, is just where exactly we go from here. When you're talking about the fact that we are at these record levels, we've seen lots of euphoria, lots of optimism, lots of excitement play out in the market and be very consistent and much more resilient than what we were expecting heading into this year. So you take that into account, also coupling that with the Fed speak that we heard earlier this week. We've kind of seen a trimming here of rate cut bets here before the end of the year. How much that matters and what that ultimately means for the markets, obviously that is up for debate. But I think what this all points to, given that uncertainty, is just maybe the volatility that we could potentially see here, Josh, over the next several weeks and several months.
I think one of the most notable things that we've heard from strategists over the last week is most people that are saying they think stocks go higher this year still think we see another pullback, right? And I think that's always important to keep talking about when we're at record levels, is that pullbacks are normal. The 5% pullback that we had in April is not abnormal. Actually, on average, you would probably have closer to a 9 or 10% pullback in a given year. So the path, like you said, Shauna, is not necessarily going to be smooth here. But right now, the way things are setting up, I think it sort of makes sense where we're at with the stock market, with the major indexes overall, right? We've been talking about a better than expected earnings season. We're seeing earnings grow at their highest level in just about 2 years. You're expected to keep that momentum going through the end of the year. So at some point, it at least fundamentally makes some level of sense, sort of how we got here.
And I think it's the additive factor of what we were talking about with Kevin Gordon yesterday and how much of a Goldilocks scenario we could have to navigate through for the rest of the year if we do continue to see new all-time highs. That puts even more pressure on companies who have already been rewarded less, even for beating both on top and bottom, and then also giving a guidance that might still be in line with what the street looks at with the valuation that's already been tacked on.
Brad, you mentioned the Goldilocks. It just seems interesting to me how quickly we shifted back to this narrative in, 2 days. And we had
How quickly narratives are shifting overall,
I don't know.
continuously,
Was the CPI print that good? Did I read the wrong report? It was good, don't get me wrong, and core inflation coming down as people had projected is great, but we've been on that path before and then it gets bumpy, right? So I think at some point, you do sort of at least question that part of the rally, maybe look at something like small cap, Shawnee, you were mentioning now back close to December levels. Yeah. That was when we were pricing in 6 rate cuts, almost 7 rate cuts. Now we're talking about 2. So it's getting a little bit mixed and muddled, I think. And again, when you think about the economic growth story, I think that's going to be the big part of the second half of the year here is we're going to be focusing on what kind of slowdown are we talking about? Because remember, yes, a slowdown in theory is Goldilocks, right? So we're not too hot. You don't want to be too cold either. Right. And I think that's something that people need to keep in mind moving forward.
Yeah, certainly. And also couple that with how well earnings hold up too in the second half of the year. Clearly some huge drivers here.
You've had a revenue problem this quarter overall, right? The story we talked about coming into earnings was that people wanted to see revenues picking up and not necessarily just protecting margins via cost cutting. And when you look index-wide at the S&P 500, it hasn't been a major revenue story. And so you wonder if that does start to pick up in the second half of the year. Right now, a lot of strategists and analysts would tell you that is the projection. So hopefully that does play out, and then maybe we do get some of these bullish targets that we have in the S&P 500.
Yeah, exactly. All right, well, let's talk a little bit more about where we head from here, because we're all trying to figure this out right now. The market rally, is it set to broaden out here for the rest of the year? For that, we want to bring in Jack Manley, JP Morgan Asset Management Global Market Strategist. Jack, it's great to see you here at the desk. So talk to us just about how you're looking at Dow 40,000, this psychological level. How significant is this at all here for the market?
I think psychologically it's sort of amusing. I mean, first of all, I remember Dow 20,000 not too long. Everybody was getting those caps.
I know,
right?
Josh sitting here aging us.
That's what everybody was so excited about right now. It's like, well, we're double that? I can't believe it. But the rally that we've been seeing, whether it's tech stocks and NASDAQs or the blue chips or whatever, it feels good to me, honestly, because the macro data have been pretty good. And all these macro data that we've been talking about, CPI, PPI, employment from a couple of weeks ago, all this stuff matters because of what it means for rates. And at this point, the market is used to this idea that the economy is a lot more resilient than we had expected 5 months ago, right? That is not a surprise anymore. So as long as the data keep on coming in where they're supposed to come in, even if that's strong, that's not a bad thing. You've already seen this massive swing in the pendulum in terms of rate expectations. It's going to take a lot more to change that, 25 to 50 basis points of cuts this year to no cuts this year, or even hikes. And we've heard that from Powell himself. So as long as markets are comfortable with where rates are right now, and rates are where they are because the economy is doing well, I think this rally's got legs, especially as we move into the back half of the year.
Hi. Sorry.
Yeah, go ahead.
When you talk about the rally having legs, how much higher do you think we could go from here?
Oh, gosh. I mean, that's a tough one. I mean, 5-10% by the end of the year, maybe. I think we've learned over the last couple of years that you never want to underestimate what the U.S. equity market is capable of. You don't want to underestimate what our economy is capable of, what our consumer is capable of. So I don't want to lowball that number, right? But for me, as we move into the back half of the year, it is all about this broadening out, because so much of the rally from last year is still being driven by multiples. I mean, you still have markets that are trading at pretty elevated levels. And anytime you're not only at all-time highs, but also at all-time highs because of multiple expansion, you're asking for trouble, right? You're asking for volatility. So the earnings have to catch up. And thankfully, those big tech names have really been pulling their weight, which is great. A lot of development on that front. But we need the rest of the index to start playing ball too. And that is, I think, a back half story. I think it helps to cushion the valuation blow a little bit, and I think it helps to lift the market just a bit higher from there.
Markets are forward-looking, and for a market that might be looking 6 to 9 months out even, when you're thinking about a portfolio pivot, what is the flashing sign that investors should be looking for in order to make sure that they're not continuing to enact the higher for longer playbook when now you're clearly getting signs that the Fed may be starting to enact now it's a rate cutting time?
So from an equity perspective, Brad, I don't think there really is a pivot necessary, at least if you've been playing it the way that I've been thinking, which is right down the line, kind of boring core U.S. equities, right? I feel like there's a big temptation right now with conversations to sort of pigeonhole yourself and say, well, is this a growthy market? Is it a value market, right? I think the pond that you're fishing in is just too big. You cannot limit yourself to a style box or one way or the other. The story for me right now has been, and I think will be for a long time, a story that has to emphasize quality in security selection. And quality there being, dependable earnings growth, reasonable valuations, strong balance sheets, and that quality being so important. And we've talked about this before. Money's not free. We spend a lot of time talking about the Fed cutting rates and when they do start to cut, how much they're going to cut by. But I can tell you with near 100% certainty that even if there's a recession, rates aren't coming back down to zero. That experiment, I think, is behind us. And if money's not free, we got to be more thoughtful about how we allocate, and that's a quality story. And I don't think that changes, even when the Fed does start to cut rates.
So, Jack, you talk about the fact that investors need to be a bit more discerning at this point. And speaking about that rotation you're expecting to see in the second half of the year, just more specifically, where are you seeing it right now most likely on a sector basis? Because we are starting to see signs of broadening, or had been here over the last couple of months.
Well, I think the consumer names are going to be doing quite well sort of throughout the year because we got money to spend and we like to spend it. I think that energy probably should have something of a kickstart because of what's going on geopolitically, right? I mean, a lot of tension around energy prices and a lot of profitability in that space. I feel like I'm beating a dead horse on the financial story, but I've liked the financial story for a while. There have been a lot of idiosyncratic issues that have hammered financial stocks at a high level, but man, if a big bank will borrow from you at 2 basis points and then turn around and lend to you at 700 basis points, that's a heck of a net interest margin, right? So I do think that it's some of those more cyclical, more value-oriented names could do something over the next 6 to 9 months, but it is broader than that, I think, over the longer term.
And I know we can't talk individual stocks here, but is there one name that could break a broader theme? And that theme has been generative AI, and that name has largely been Nvidia to this point, a company that's reporting earnings next week here. Is that theme ironclad enough, at least as of right now, in the demand profile that we've seen, regardless of what Nvidia says?
Yeah, that's a really tough one. I think it might be one of the more important questions that we have to ask as equity investors is this AI stuff the real deal, or is it a flash in the pan, right? And I mean, I think, frankly, that the jury is still out on whether or not AI will fundamentally transform the world. I mean, there are certain pockets of industry that are already being augmented and elevated by artificial intelligence. And you hear about some really interesting use cases in the healthcare space. I mean, I was talking to a client a couple of weeks ago who was saying that artificial intelligence is a better salesman at drive-thrus than humans. They're better at upselling you. Hey, you want to supersize that?
They know
hey,
I want the
you
hash
want a
brown.
milkshake?
Yes.
They know,
so
and they'll
scary
ask
on
you.
so many
It's
levels.
crazy.
Yeah.
It's totally crazy. So there's some really interesting use cases for this stuff, without a doubt. But is the whole world going to be transformed? Maybe, maybe not. And even if it is, it's not going to happen in a month or 6 months or 12 months. So this is a long-term play. And we keep on seeing interesting things crop up. I'm not going to say name names, but there was an interesting demo that was released a couple days ago that shows just how impressive some of this technology really can be. It's a little bit shocking, frankly, but I think if markets wake up to say, hey, maybe we got a little bit too excited about this, and maybe we pulled forward some of these earnings just a little bit, and that's reflected in those valuations, that's where I think you have potential for a bit of a shaky road.
I mean, it's already starting to talk to us at this juncture. So we'll see. We'll see what people are comfortable with and what they're fading a little bit within their technology at their fingertips. Jack Manley, JP Morgan Asset Management, Global Market Strategist, joining us here today. Thanks so much, Jack.
Thanks, guys.
Absolutely. All right. All you.
Okay. Another stock that we're watching here today is Reddit. We were just talking about the excitement surrounding AI. Let's talk about this move that we're seeing in Reddit today because it's to do with AI. You're looking at gains of just about 9.5% here in the pre-market. Now the move higher coming after the social network company announced a new partnership with OpenAI. Under the agreement, OpenAI will have access to Reddit's data, giving the artificial intelligence startup a chance to use Reddit's content in real time. When we talked about the excitement surrounding Reddit following its IPO, a lot of that excitement was driven by the AI potential and exactly what that means here for Reddit in the long term. So on the heels of this licensing deal, to no surprise, we're seeing the stock move higher here in early trading. And Brad, when you take a look at exactly what this means ultimately here for Reddit, just quick glance at early analyst reaction here. Citi's Ron Josie saying that OpenAI licensing deal showcases, quote, the value of its data corpus, and OpenAI's agreement should provide ChatGPT with a continuously refreshed source of human conversation at scale. So they're looking at it as a win-win here for both companies.
I mean, Reddit signaled it. Reddit signaled it coming into the IPO. This was in the S1 filing that this was how they saw their business being monetized by partnerships like this. I think the revenue sharing that they're able to enter into is really going to be the stickier part of this for investors as they start to get some details in future earnings reports just about how much in pass-through revenue they're able to ultimately see and net out as a result of partnerships that are really gamed from generative AI, looking at the human and conversational element that takes place online, indexing and ranking that ingestion of data. And so I think on top of the advertising realm that Reddit still does have and is more prominent at this juncture in its revenue base, this generative AI kind of indexing of the data is that next major element that they talked about leading up to this IPO. And once again, investors are going to hear about that for a long, long time here. Also, let's talk about shares of GME. GameStop, the stock tumbling 21% after the video game retailer issued a profit warning ahead of its first quarter earnings. The company also said in a separate filing it plans to sell securities for an undisclosed amount. Shares are down by about 21%, kind of a double whammy here. And I'm going to focus in on the selling of securities, actually. This should come as no surprise to some of the shareholders out there that may have piled into GME over the past few days because it's a lever that these companies are able to pull when there are this many people that are investors, traders that are buying into their stock. We've seen this with AMC before, doing at-the-market equity offerings. In fact, back then in 2021, to try and make sure that they could boost their liquidity position, they did about $1.25 billion in at-the-market equity offerings in that wave. And it was coming, of course, kind of in the downdraft of everything. But all these things considered, they're looking at this as a clear opportunity to cozy up to investors who might still be out there, might still be interested, and improve their own cash position at the same time. So this should not come as a surprise for GameStop to be pulling that lever.
Yeah, it certainly doesn't. And GameStop saying that they could potentially use these proceeds for, quote, general purposes, also may include acquisition. So talking about maybe trying to get their business in a better spot, fundamentally speaking, than we are here today. But when you take a look at that action, we just had a longer-term chart there up on your screen, but taking a look at the action even since the start of the week here, it certainly has been dramatic, these moves that we've seen in GameStop, that we've seen in AMC, that we've seen in so many of these meme names as the retail investor really coming back in on the heels of that tweet from Roy and Kitty over the weekend, seeing reason, at least in their minds, to buy GameStop at these levels. And as you take a look at that 1 week chart, you can see the decline that we've seen over the last 2 days when about $7 billion was wiped out from GameStop and from AMC, and clearly more pressure here today. But again, it's a volatile trade, to no surprise. Similar, not in scale to what we've seen in 2021, but I would say just in terms of the retail investor excitement and some of the narratives that we are talking about now, it does mirror similar to what we were talking about in 2021, although clearly wide differences there that remain on what we're seeing today versus 2021. But again, we could potentially see a bit more selling here today and then into next week as we do pull back from those highs earlier this week that everyone has been continuously scratching their heads on.
Yeah, 2021 was more of the, okay, to the moon, and this was more of
there's no stopping it.
This was more like a trampoline.
Yeah, for now. Yeah. We'll see. All right, coming up, a double upgrade for Robinhood, sending shares higher. We're going to break down some of today's top trending tickers next.
Microsoft announcing it will begin offering its cloud computing customers AMD's AI chips, a move which will give users an alternative to Nvidia's processors. Microsoft is expected to announce more details at its Build developer conference next week. You're taking a look at shares of both companies here, moving higher pre-market, but AMD, the outsized move there, it's up by about 3.5% on this news. I did a lot of learning about actually what it takes for these artificial intelligence chips and the broader data center and what's taking place. Well, it's a cluster thing. Microsoft's clusters, apparently, of the AMD AI chips, they're going to be sold through this cloud computing service, of course, that Microsoft has, Azure here, and ultimately for AI models and applications to run, these businesses actually have to put together or cluster multiple GPUs here. So that from some of the great reporting out of Asia.
Yeah, and it's interesting here when it takes a look at ultimately what this could mean for AMD's business. AMD expects $4 billion in AI chip revenue this year, has said that the chips are powerful enough to train and run those large AI models. When you take a look at that and coupling that with exactly what this ultimately means here for this business here, we are expected to hear a little bit more details when Microsoft does hold its event, but clearly there's a lot of excitement surrounding the potential here of this partnership and what exactly that could ultimately mean here for both of these companies. And then you've also got to ask what this could mean here for Nvidia as well, and whether or not how much market share this could potentially take from them or pressure this could ultimately put on the business.
Yeah, I mean, I guess with the clustering that takes place in data centers, it's actually more advantageous to have multiple different types of chips running for the large language processing. So that is something that is far over my head. I would love to get an expert on that, but no doubt the stock movement is not over my head. You're taking a look at AMD shares as we were just a moment ago here, up pre-market 3.5% on this news, and you got to wonder how this company is also going to be drumming up some of the other major deals here that are similar or synonymous to what they've just been able to do with Microsoft year to date. Company up by about 17% right now.
All right, let's take a look at Take-Two. That stock on the move, posting a $2.9 billion loss in the fourth quarter, sending the stock lower. The company also announcing its Grand Theft Auto. It will not be released until the fall of 2025. That's huge news here for the company. You're looking at losses of just about 0.2% here in pre-market trading. When it comes to analyst commentary, you got Jefferies out saying that yes, the results may have been better than feared, bookings beating expectations, but the full year 2025 guidance came down here for the third quarter in a row. And then you've also got Grand Theft Auto not launching now until a delayed time frame of fall 2025. Not exactly what many analysts and not exactly what the street hope to hear from these results, to say the least.
Yeah, some bright spots. NBA 2K24 did well. Zynga's in-app purchases led by Toon Blast and Match Factory. All you people out there playing on your mobile devices, that helped out a little bit. And then additionally, Red Dead Redemption series, not my top favorite player, but game, but hey, it's for people out there. One of the huge things though, the recurrent consumer spending, that actually declined by about 2% for the period and accounted for 79% of net bookings here, but that also gives you a little bit of the mindset into the consumer that's in a gaming realm and trying to figure out, okay, where does it make sense for me to pay more in the in-app or in-game experience here, and any signs of weakness similar to actually what we were talking about even with Roblox as well this most recent quarter. So that kind of being one of the common denominators or the threads in these gaming companies right now.
All right, let's take a look at Robinhood, another stock that's trending here on Yahoo Finance. A double upgrade from Bank of America. They upgrade the stock to buy, and that's up from underperform, sending shares to the upside. You're looking at gains of just about 6%. The analyst behind that call is saying that they view the current entry point as, quote, the total opposite of 2021. And remember, in 2021, you might not remember, but that is when the firm initiated coverage on the stock with that underperform rating, and why they're saying that's a bit different than what it was in 2021. They're saying that right now, rising retail engagement, accelerating organic growth. They have positive operating leverage after large expense reductions, and then also just an attractive valuation here. And this comes following the massive surge, actually, that we've seen in Robinhood shares since the start of the year.
Yeah, it'd be interesting to see if investors buy this one. And here's why. Robinhood is going to be annexing itself just a little bit more closely to crypto than we had seen even back in 2021. They just allowed or just announced one of the staking parts of the business as well. That's going to be Solana staking product for European customers here. And then there's going to be some customer acquisition costs, at least in this near-term period, offering a 10% bonus for the first 30 days on platform. So once you get past those customer acquisition costs and start to look under the hood at the customer lifetime value that you're getting from some of those new members who are trading on the platform, it's a larger question of what they are trading and if they are buying into more of the crypto side of the business that Robinhood's cozying up to just a little bit more, or the options equities side of the business where ultimately, I think for right now, there's been so much fanfare, at least within the consortium of traders there, or the group of traders on Robinhood, among some core themes. And it's been the core themes that have run away for the market right now. It's been the themes like generative AI. It's been themes around some of the biggest tech companies that have just been overcrowded trades. And so if you see more of those overcrowded trades, it's a larger question of, okay, where does that rotation take place once you do see some profit taking from some of those core users? And do they continue to transact within the platform?
And you got Bank of America upping their price target here. It was initially $14. Now their new price target of $24 a share. So about, what, $7 higher than where we're trading today.
I'll buy it.
All right, just minutes away from the opening bell on the street. You're looking at, we could see a mixed open here in just 2 minutes. We'll be right back with the opening bell.
Not me, bye. Oh yeah, you're taking a look at the NYSE. Oh, big baller energy down there. The WNBA ringing the opening bell on Wall Street. And in Midtown Manhattan, you've got the great folks from Hideleo, Hugo, ringing the opening bell there. Oh my gosh, do you see any of are there any players there, or is it Kathy?
I was trying to get a closer look to see if Caitlin Clark was up there, but I don't see Caitlin Clark. It's a small picture though, but it looks like Kathy Engelbert there,
yeah.
The commissioner of the WNBA, ringing the bell. We know they had a new season kicking off this week. Did you see all the Caitlin Clark jerseys?
I watched the debut, actually. I watched her first game.
There's a lot of excitement. Impressive.
Yes, let's do it.
Exactly what we thought we were going to see from Caitlin Clark so far. All right, let's take a look at where we are today. This market check sponsored by Tasty Trade. You are looking at a bit of a move, actually, to the upside that we're seeing right now at the open as things shake out. Taking a look at the Nasdaq right now, also a brief move to the upside, just about up 0.1% as we do wait for things to open up here. And you also got the S&P 500 pushing above 5,300, a couple of critical levels to watch. Let's talk about that sector action that we are seeing first on an intraday basis. We do have materials, energy leading the way. Flip side, consumer staples and utilities, two names that have been catching a bid here most recently. They're actually in negative territory, at least right now, although it's very, very early. And taking a look at the 5-day chart, the action that we have seen this week, technology by far the leader so far, up just about 3.5%, Brad.
Yeah, we heard you like technology, so let's give you some more technology in the kind of a la mode of exhibit. Pimp my ride. Anyway, taking a look at the Nasdaq for the past 5 days, we're taking a look at some of those technology players. Microsoft up by about 1.6%, but look at Apple and Nvidia right now. Nvidia, of course, this week's performance coming ahead of that earnings report next week, and so we're going to be keeping close tabs on that as this company has absolutely been off to the races over the start of this year. We'll see if they can add on to that 90% gain that they've seen thus far. Tall task. We'll see if they can do it. But all these things considered, it's been a wild ride thus far.
They've lived up to those lofty expectations the last couple of quarters, so we'll see. But again, it's amazing that we've seen this jump of 90% again since the start of the year. All right, today's big news, the Dow, right around 40,000, that record high level milestone that we first hit yesterday. We're trading just below that level. Now, this recent move higher coming following that's softer maybe than expected inflation print. It was pretty much in line with the street's expectations. That renewed some hopes of rate cuts, although we are seeing a bit of a repricing here today. Now, this comes after a month-long rally that has pushed all three of the major averages here to closing highs. Our next guest, though, saying that despite some of that positive econ data, there might be some macro headwinds ahead. So let's talk about it. We've got Rokhaya Ibrahim, a BCA research strategist, is here. It's great to see you here. So I'm curious how you're taking a look at these record levels, some of this optimism that we have seen continuously play out here in the U.S. equity market, and what that ultimately means here in terms of that momentum trade and where we head from here.
Right, you're right. There is a lot of optimism in the market right now. And what we've seen over the past month or so is that the narrative has sort of shifted from, a no landing narrative to one that's sort of like a soft landing narrative. And that's really what's supporting the market right now. But, this could continue over the next couple months. But when we take a look at what the cyclical outlook is, as you mentioned, we think that there are some headwinds in the economy that are going to then weigh on the outlook for equities. And so when we are looking at these headwinds, it's really, the U.S. consumer that we're concerned about. They're ultimately the driver of the U.S. economy. And we think that, the situation is going to be a lot grimmer in 12 months from now.
You define the consumer right now. I mean, we've heard this definition or, how they've been categorized, how we've been categorized really changed over the course of the last year, from resiliency now to what we were hearing from Walmart's CFO when we spoke with him yesterday in relatively stable here. How are you monitoring the situation there?
Absolutely. When we take a look at the consumer, I think there are three main things that is driving consumer spending. First of all, it's their savings. And what we've seen over the past year or so is that the excess savings that were built up during the pandemic have come down and they're being depleted. And so the savings rate, we expect that to rise, and that will hurt spending in the process. The second main component is the income. So we're seeing wage growth slow. We're seeing some signs that the labor market is deteriorating, and that is going to weigh on the income of the consumer. And the third main pillar and the final pillar is the borrowing, borrowing from their future earnings. And what we're seeing from things like the sluice is that, banks are tightening lending standards, and that's negative for consumer borrowing.
What's going to be enough to keep some of this move to the upside, this optimism alive? And if we're due for a pullback, is that actually something that investors should be viewing as a healthy move then here for the market?
Well, yeah, I do think that the S&P 500 is quite richly valued right now. It's not where it was, let's say, during the dot-com burst. If you look at the forward PE, right now it's around 20. But if you take a look at something like price to sales ratio, it's quite higher than where it was because of elevated profit margins. And that's another thing that's probably going to weigh on the outlook for the S&P 500 is that these profit margins are probably going to come down a little bit. And that's going to weigh down on the outlook, especially even if we don't get a very even if we get like a mild recession, that is going to weigh on the outlook for on equities because they're so richly valued right now.
After times in the past where we've had such a pile into one specific theme, and in this case, it's generative AI and it's a lot of the overcrowdedness of tech, where do we see that broadening out typically take place thereafter?
Yeah, I think that investors are very optimistic about this AI developments, and there is reason to be optimistic. But I think that they've brought a lot of that future optimism forward, and that's really boosting, these tech stocks. And that's what really is keeping them very highly valued. And I think that if we do have a macroeconomic environment that's deteriorating, they're going to be more susceptible, to some declines because they're so richly valued right now. And so we're looking to shift towards a more defensive positioning in terms of U.S. equities, favoring things like utilities, healthcare stocks, consumer staples that would probably do much better relatively better in a situation where the economy deteriorates.
Ricardo, talk to us about some of the excitement that we certainly have seen investor sentiment surrounding commodities. We have seen this move, this leg higher when you take a look at the price that we're looking at in crude. When you take a look at copper, for example, when you take a look at gold, what does that signal to you as the investor and just in terms of where we are within this cycle?
Yeah, that's a great question. I think when you take a look at what's happening with commodities, there are a few things going on. Commodities are typically a good inflation hedge. What we've seen over the past month or since the beginning of the year really, is that concerns about inflation being stickier than expected have supported demand for inflation hedges. And so things like commodities benefit from that. There's also these geopolitical risks that are happening and impacting, oil markets, and that's supporting oil prices, although they have, of course, come down. And those risks seem to have ebbed, at least based on the behavior of investors. And typically, commodities do well in a late cycle environment. And so what we're seeing right now is most likely this sort of behavior reflect the late cycle environment that we're in. Commodities do not lead the S&P 500 in sniffing out a recession, and that's mainly due to energy. So energy prices typically peak after the S&P 500 and usually after a recession. And so, seeing these commodity prices rise is not necessarily a signal that the economic environment is going to continue remaining resilient.
Ruqayyah Ibrahim, BCA research strategist. Thanks so much for taking the time here with us today. Really appreciate it.
Thanks for having me.
Certainly. Well, coming up, copper is surging in 2024. We'll break down what's behind the move. That's next. All right, for our vibe on the street today, we're diving into the meme stocks. It's been a wild week, and it got even more interesting this morning on actual fundamental news. GameStop shares are falling sharply after the company said it plans to sell an additional share count, plus reported preliminary results that showed a drop in first quarter sales. Now, they haven't said how many shares they're going to sell just yet, but shares are still reacting here. The stock rallied earlier this week, fueled in part by posts on X from Roaring Kitty, aka Keith Gill, one of the key figures in the 2021 meme stock mania. Yahoo Finance's Alexandra Canal joins us for our vibe check. Okay, what's the vibe on the memes?
You know, for me, Brad, the vibes are simple. This is all for fun. We are not serious people. This was a silly little blip to start our week, and now the rally is losing steam. Now, that's not to say we didn't see some pretty serious moves here. I think the 5-day charts of both GameStop and AMC really emphasize this point. At their peak on Tuesday, GameStop shares were up nearly 250%. AMC was up more than 200%, but then we saw this drastic swing down. And this really proved that the rally was largely unsustainable and that this wasn't a repeat of 2021. So that, I think, is the takeaway here. And there's not a lot of panic among strategists. They're pretty much saying, keep calm, carry on, this was fun. Now we move on.
Yeah, and I think a big difference here when we compare it to 2021 and what we're seeing here today, or a big difference, I would say, is just in terms of where we're seeing the institutional sides of things, just in terms of their quickness to respond. They clearly had some lessons learned from 2021. They're more ready this time around. But I think there are some similarities or parallels that we can draw just in terms of the frothiness, the overexcitement, and maybe the fact that investors could be a little bit bored at this stage of the cycle and trying to add a little bit of excitement here within their portfolios.
Yeah, and look, Keith Gill, he is clearly someone that can rally the troops.
Yeah.
He has this cult-like following, and it's something that, like you said, is fun at the end of the day. Now, the difference here from 2021 is that in 2021, we had a lot of extra stimulus money from the government. That is one thing. We also had a lot of people, like you said, bored at home due to the pandemic. But today, like you said, with the frothiness in the market, that could be something that really encourage investors to get in there, gamble a little bit, have some fun, join the Reddit craze. Hence why we saw this peak one day, and then really starting Wednesday, we saw this come down pretty significantly. Now we're still up on the week, fairly a lot, but compared to where we were, not nearly as much.
Yeah, and I think a lot of times the consensus here from the street, it's very dangerous to short some of these meme trade stocks, obviously, when you take into account what has happened here and everything like that. So I think a lot of lessons were learned from 2021. Naturally, there are a lot of comparisons just given the excitement that we are seeing around the same names that we were talking about 3 years ago. But like you correctly pointed out, and very important to point out, there are massive differences compared to what is playing out now versus what played out then. And this is almost just a blip. What do you compare it to, a trampoline?
Oh yeah, this is a trampoline versus a to the moon versus a rocket. Yeah,
I
versus
love
that
that.
Blue Origin trip that some people might be saving for.
And there was data that actually backs us up. Vanda Research had some interesting stats that GameStop saw net inflows of 15.8 million on Monday, AMC 37.5 million. Yes, that's a lot of money. But if you compare that to 2021, 87.5 million for GameStop and 170 million for AMC when it comes to those peak inflows in a day. I mean, that speaks largely to me that the data speaks for itself, that it's not 2021.
Can we toss up that 5-day chart just one more time here? Because this is a textbook almost island reversal that people are looking at here. Yeah. And, you know, not to get too technical in here, but of course, you had your fanfare, you got your island, and then your reversal came in. That sets in. Plus, you've got the additive of what GameStop announced today, which should come, as we were mentioning earlier, to no surprise. AMC did this back in 2021 to capitalize on the amount of people that were now not only investors, but some of them might have been customers trying to catch a good flick, a good movie. And so many of the executives, their rights to capitalize on this to increase their liquidity position, but that also dilutes shares at the end of the day, too.
Right. You have to think they were thinking on their feet fast. Like, we got to sell shares soon now, considering we don't know how long this is going to last.
And a big reason why a lot of the strategists and many people on the street were saying that the chances are that we get to that stage back in 2021 clearly extremely low, and we've seen that play out in the markets this week. All right, coming up, let's talk about another trade that's hot for some people here. We've got copper. It's surging so far since the start of the year. We're going to break down what is behind that move higher, nearly 30% gain when we come back. Copper prices, it's been on a massive run since the start of the year. You can take a look at this move to the upside here on your screen. Year to date, we're looking at gains of just around 30%. Now, this latest move higher that has really picked up steam here in the last couple of trading days, a lot of that has been attributed to this supply squeeze that we've got going on, the surge in demand that we will likely see for AI, green CapEx spending that's likely to go on. That has been fueling this surge that we are seeing higher in copper prices. So here we are today with that jump of just about 30%. Now, I want to point out what has really stuck out to me is the difference of what we're seeing, the divergence between the pricing in New York and in London. When you take a look at that gap that's playing out for the June and July, you can see a massive gap here. Citi in a recent note pointing out that that's normally around 90 bucks at 90 bucks a ton here, and we have certainly seen that wide divergence here, almost at record levels. So that, of course, kind of points maybe to the squeeze that could potentially be happening here as traders maybe try to position themselves for what they expected to see in terms of snapback of that premium in the price of the U.S. Copper right now, but clearly that has yet to take place. So an interesting dynamic that is going on in the price of copper right now, and also to compare that to some of the excitement that we've seen in other commodities. First, let's take a look at gold, because when you take a look at the price of copper versus gold, you can see copper is even outperforming gold here, really taking over at the end of last month. You can see gold futures up just around 17% year to date versus almost a double here that we've seen in the price of copper, which is up just about 30%. And we have seen this shift to many of these commodities here catching a bid. We were talking to a guest earlier, a strategist earlier in the hour, talking about the fact that some traders are trying to hedge against inflation, buying some of these commodity prices. So that has been fueling some of the gains. But we've almost seen this excitement play out across the board. And we want to take a look at the gains that we have seen more broadly speaking beyond commodities year to date. And this is a great chart here. You've got copper, by far the outperformer. When you take a look at some of these sectors here or plays, that's up 31%. Like I said, you've got tech stocks and gold, both up just around 20%. Utilities also catching a bid. So you've seen this excitement play out in equities, in gold, in copper, commodities. So investors really trying to find different pockets of the market, trying to position their portfolios best for certainly an uncertain couple of months ahead. So here to talk more about what is driving copper specifically higher and where do prices go from here? Is there much upside here from these levels? We want to bring in John LaForge. He is Wells Fargo's head of real asset strategy, joining us now. And John, talk to me just about what you attribute this recent rise to and whether or not there is much room to the upside from these current levels.
Well, I'd say that the most recent move, so this move to let's call it $4 a pound to $5, was more speculators. It was essentially contract-based. There was an arbitrage going on. So essentially you saw a little bit of a short squeeze. But that can only really happen because underneath the surface, you have these fundamentals where we frankly are not producing enough copper. And yet there are buyers everywhere right now for copper. Across the globe, you have, it doesn't matter if it's China, India, the United States, everyone's pushing to go green. And copper is the #1 metal when it comes to that type of future. There's really no substitute for what copper does. And so underneath the surface, you really have good fundamentals. But I'd say this last little move, so we're up 30% on the year. Let's call it the last 10 to 15% was much more speculator based and wasn't about fundamentals.
John, to the extent that we can, what is the kind of, as you were mentioning, the international marketplace here for copper as well? To what extent is this and the broader commodities landscape right now really hinging on geopolitical kind of factors?
For copper, not much. What's generally happening now is if you go back since COVID, commodities are one of the best performing major assets out there, period. They kind of go under the radar, and that's across the board. And that's because, frankly, it's not geopolitical. It's the fundamentals underneath commodities. There isn't enough supply. Demand tends to rise through time. And I'm talking decade after decade after decade. Mankind uses more and more commodities. So you have demand going up all the time, just a little bit, 1.5% a year. supply is the kind of key in here. So the last 4 years, we haven't had enough supply across the board, whether you're talking copper, gold, oil, it almost doesn't matter. So what you really have is a commodity super cycle that started 4 years ago that's pushing all commodities higher. So I'd say it's less geopolitical and much more the underlying fundamentals. You probably have another 6 to 10 years left of really strong commodity performance.
Well, that really puts it in perspective. John, I'm curious when we talk about the divergence or the gap between what we're seeing the pricing action in the U.S. versus what we're seeing in London, that chart that we had up there earlier in the segment. Is that because, going back to what you were just saying about supply is tighter here in the U.S.? Or talk to us just exactly why we're seeing such a wide gap.
Yeah, supplies are tighter here. So you have a lot of the refiners, take the Chinese refiners, are trying to get ships and trying to get it here. So the situation, if you look at Shanghai, it's not nearly as dire from a supply perspective. In fact, inventories right now for refined copper are at, let's call it 2.5-year highs in Shanghai. So it's not that bad. This is much more about futures contracts and something quirky that happened in the United States, that we were running dry on refined product. And you had some speculators come in and take advantage of that on a futures basis. Doesn't change the fact, though, we're going to look out a year from now, and 2 and 3, and we're probably going to be stuck with the same dynamic, which is you have roughly about 5% more demand growth in the world than we do supply growth with copper. So prices are going higher longer term. Maybe this little squeeze we've seen deflates a little bit over the coming months, but generally I'd expect prices to be higher.
Is copper a perhaps annexed chip trade here as well?
No, I mean, we could frame it that way in the short term. I kind of like that. But generally, no, I'd say if you look around the globe, we just don't have the supply. So we could say it's some type of chip play or arb play between China and the United States and so on. But if you look at the major producers in the world, the countries, this is just about supply. Only the Congo saw an increase in ore production, copper ore production last year. The other major areas, all flat. Last year, all flat. And we're talking US, China, Canada, you name it, right down the line. We just don't have the ore production. And yet, if you think of the globe, everyone's kind of in this, I don't want to say irrational world, but they just want to be green. So price doesn't matter as much, and they just kind of push forward. So I'd say it's, chips, of course, use a lot of copper. Same with, EVs and you name it, but I wouldn't put it on chips. I'd put it on just generally, there's a lot of buying, and it's not always rational buying. They're just willing to pay whatever price there is out there because they want to move forward with, again, whether it's chips, green, world, you name it. It's kind of this buying that's persistent and isn't going to stop anytime soon.
All right, John LaForge, always great to get your insight. Thanks so much for hopping on with us this morning. Wells Fargo, head of real asset strategy. We appreciate it.
Thank you.
Coming up, Madison Mills, she's joining me for Catalyst in the next hour. Markets are at all-time highs. We're going to kick off the show with a strategist that now has the highest year-end target for the S&P 500, 5,600. He thinks we're going to see a rally from these current levels where we're hovering just around 5,300. Brian Belsky joins us after the break.
It's 10 a.m. here in New York City. I'm Madison Mills alongside Shauna Smith, and welcome to Catalysts.
It's Friday, May 17th. Let's dive right into it. The catalysts that are moving markets this morning. The Dow hovering just below that critical 40,000 level, the milestone that we first hit yesterday as investors weigh the Fed's path forward. Now, the Dow, though, it's important to point out, isn't alone. You've got the S&P 500 and the Nasdaq also hitting record highs this week. We'll see whether or not we will get back to that 40,000 level here today, Maddie.
That's right. And next week, the rally facing another big test with Nvidia's earnings. Can the chips giant deliver on the street's high expectations?
And meme stocks taking another leg lower today after GameStop warns of falling sales and also plans to sell shares. This comes after a two-day sell-off that wiped off about $7 billion of prior gains from both GameStop and AMC. Well, first, our big story, and that is markets just at record highs here today. You've got the S&P 500 just around that 5,300 mark. The Dow hitting 40,000 yesterday. Our next guest seeing more room to the upside. He's got a year-end target for the S&P 500 of 5,600, the highest call on the street. So let's bring him in. We've got Brian Belsky, he's BMO Capital Markets, a chief investment strategist. Brian, it's good to see you. So you and I were talking not that long ago. You sounded awfully bullish for your previous S&P target. Now you're raising. Why now, and what's the catalyst?
Shauna, good morning, and good morning, Yahoo. A lot of people were accusing us of being bearish because we said in late February that the market was getting a little tippity-toppity and needed to be a little sideways here, especially considering the type of move that we saw. You know, we really believe, first off, that U.S. stocks are in a 25-year secular bull market. Number two, we believe that the cyclical portion of the bull market, meaning this new cyclical bull, started in October of 2022. Typically and historically, the second year of a bull market has an average correction of 9.6%. And we didn't see that. We only had like a 5% correction. And so given what we're seeing in earnings, given what we're seeing and hearing from what the Fed's going to do, and we think equities now are becoming an increasingly important part of people's asset mixes, especially considering what's gone on in the bond market in the unwind of what we'd like to call the 40-year bull market in bonds, we think that there's more upside. And so it doesn't mean that stocks are going to be linear forever. We are going to see some sort of a normal correction. And I think that's a better buying opportunity. But for now, I think the screens are green and the skies are blue, and we're going to have a little bit more upside here.
Brian, what do you think that correction, that short-term correction, could look like?
Well, I think it comes from a higher level. So, a lot of the technicians out there use this phrase higher lows. I think this year is going to be a period of higher lows. So I think the correction comes from a little bit higher prices. And so it would be from a technical perspective and from just a pure health perspective of the market, it would be nice to take a bit of a breather here in the bull market and the upside price appreciation. Take a respite, get ready for the summer into the fall. And I think fourth quarter in particular, especially post-election, will do very well.
But Brian, what would the catalyst for that pullback be? I mean, this market is acting like that CPI print was the best thing it's ever seen, and it really wasn't that soft.
No, it wasn't. That actually is a really great point. I think that we as investors have, and we've reared an entire generation of investors that only believe that stocks go up if interest rates go down. And if you think about it, we entered 2024, meaning the stock market and the investing world, thinking and believing that the Fed was going to cut 6 times. Well, all of a sudden that changed. And as early as 10 or 14 days ago, people were talking about the Fed raising rates. And so I do think that we're transitioning, quite frankly, into more of a trading range environment, more of a focus on the stocks versus the forest through the trees. Let's call it, versus all this macro data. So what could be the catalyst, I think, for a pullback would be some sort of a near-term scare in interest rates, some sort of a near-term momentum change, whether or not it's geopolitical or not. I don't think it's fundamental. Why I don't think it's fundamental is because the earnings prowess of the United States stock market is very strong. The cash flow strength is strong. Return on equity is strong. And we do think actually there's a portion of the market, quite frankly, where numbers are too low, especially namely in some consumer stocks. But financials, I think are an area where analysts have been too conservative in their outlooks. And I think a lot of earnings power will come from the financial sector.
Well, Brian, let's talk about earnings. I always love to monitor mentions of things in earnings. That's always fun. Pricing power mentions are down. Expense management mentions outpacing pricing power mentions by quite a bit here. Can companies in the S&P expense manage their way to 5,600?
They've been expense managing their way through the last 15 years for all intents and purposes. It's called under promise and over deliver. We on Wall Street as investors or portfolio managers, which we are as well, we love it when companies cut costs and shut down divisions and restructure, because it shows that they're having discipline. That's why if you take a look at free cash flow and you look at the operating performance, whether or not it's return on assets, return on invested capital, return on equity, has been so strong. We think too, from the discernibility of earnings and the consistency of earnings is stronger that we've seen in prior big bull market cycles. And so to me, this reminds me a lot more of the mid 90s prior to the irrational exuberance of 1996, which, oh, by the way, had nothing to do with tech stocks. Had everything to do with the consumer staples area, which you're talking about pricing power. Like, remember, the consumer staples sector benefited from food inflation, and their earnings have been strong. Now you're starting to see those stocks roll over. That's why, like a stock like Walmart, it's just a juggernaut. They've done an amazing job with their inventory in their stores and especially in the grocery side. But that stock in particular, I think, is kind of bucking the trend in a consumer staples sector, by the way, which we think is increasingly expensive, and one we think you should ignore aside from, let's say, Walmart and Costco.
Brian, going back to where you are seeing those opportunities within the market, you mentioned financials. You've been overweight that sector now for some time. You're expecting that outperformance here when it comes to future earnings. Where else are you seeing that opportunity? And has that at all changed from when you initially came out with your S&P target for the year?
No, it hasn't changed. I mean, we're right now positioned as a barbell, right? Overweight, technology and financials. And I think the difference with technology the second half of the year is, dare I say, they're not quite second tier companies. They're not Microsoft and Apple, which are really the part in Nvidia, part of the Magnificent Seven, which, oh, by the way, number 7 in the Magnificent Seven is Berkshire Hathaway. So their financial stock has kind of snuck into that. Be that as it may, I think stocks like Qualcomm and AMD and Broadcom and Oracle and Salesforce and Adobe, some of these second-tier companies relative to the top ones like Microsoft and Apple, I think are going to take more buying power and more kind of increased money. I think, too, that we've seen an overall broadening out of the market. You've seen the equal weighted S&P hit new highs. You've seen, look at small and mid cap are doing very well as well. And I think that's the opportunity there. So I think an overall broadening out. And then don't also forget healthcare. Healthcare is the second largest sector in the market. And I think healthcare, aside from so much as focus has been on Lilly and the like, which we are very fortunate to own the stock, but the United Healthcares and the Mercks and the Amgens of the world, I think, are stocks that could do very, very well the second half of the year.
All right, Brian, we're going to have to leave it there. Thank you so much for joining us. We really appreciate it. That was Brian Belsky.
Thank you.
He is BMO Capital Markets Chief Investment Strategist. Now, investors are looking ahead to Nvidia results next week, which could drive more momentum in the current market rally. Shares of Nvidia have significantly outperformed the rest of the market for the last year. They are up a whopping 96% year to date. The big question, though, can the chip-making powerhouse deliver on lofty expectations? Joining us now on this is our very own Miles Upland. Miles, thank you as always for being here. I mean, can they pull it off?
Who knows? Well, I guess we'll have to find out. I think that, in the context of what Brian was just talking about with respect to the overall market rally right now, the shape of that rally, the drivers of that rally, Nvidia is a report that everyone's been eyeing for quite a long time. And obviously, the pricing structure around it, how investors expect this to factor into the overall situation, that hasn't changed too much. It's still a high volatility event, both for the company and I think overall. But the context in which they're reporting has changed quite a bit over the last month, in that there's now much more enthusiasm from investors around what the earnings picture is going to look like, not just in this quarter, but over the balance of the year. As Brian was discussing, the fundamental idea, like the idea there will be a fundamental reason to see a 9, 10, 15% pullback this year has really faded in investors' minds. So I will be curious to see if Nvidia becomes a much more specific AI trade, and like how could it be more specifically AI? But I mean it in the sense of all those pullbacks we saw at the beginning of earnings season, the TSMs of the world. Does that come back for Nvidia, but does the market kind of move on anyway?
I guess put it even more plainly for the viewers, just how significant this one report really is for the market. I mean, you're talking about these growth rates that we've seen at Nvidia, also just how unusual it is. And we pointed this out in our morning brief here this morning at Yahoo Finance. Julie Hyman wrote it. But when you talk about how unusual it is for this type of growth to continue when you got a company at this size.
Yeah, it gets back to a conversation that sort of picked up at the end of last year, which was, are we sure that the semiconductor industry is no longer a cyclical business? Because it has long been a heavily cyclical business, and that meaning there are times at which you see order growth 100% plus. I mean, Nvidia has seen revenue grow and earnings grow much more aggressively than that over the last several quarters. And then there's a time when you start to see a pullback. And we've had a lot of CapEx from the biggest tech companies already outlined. Those are going to be many of Nvidia's customers. So analysts can do the math on what that implies in terms of the growth rate for the company. But we're really talking about what's 2026 look like for Nvidia? What does 2028 look like for Nvidia? And how much has that story changed? And, you know, to Julie's point, you don't typically see, again, in whether it's a company of this size, Nvidia obviously, you know, many trillions of market cap, you know, 2 trillion market cap at this point, not only companies of that size, but industries in which there is such a cyclical component to it, growth rates like that continue indefinitely.
All right, well, it's clearly a story we will be covering very closely here at Yahoo Finance. Miles, amazing. Thanks so much. All right, another stock that we're watching today is GameStop. We've got shares of the meme stock here falling this morning. You're looking at losses of 23%. A prelim results here showing a drop in first quarter sales. They also issuing here a plan to sell shares, and that's really what is moving the stock here in early trading. We want to talk about all of this and what is next for GameStop and the meme trade at large. For that, we want to bring in Michael Pachter. He's Wedbush Equity Research and Managing Director. Michael, it's great to see you. Before we get into it, just first, your quick reaction to the news that we're getting out on GameStop this morning.
Well, I think they're pretty smart. You definitely have to give them credit for capitalizing on the opportunity to build their war chest. I'm not seeing anything in the pre-announcement that tells me that the business is turning around, but at least they'll raise enough cash to last them another 3 or 4 years if they in fact continue to flail and try to find a new strategy. So I admire that they're taking advantage of the opportunity. That's probably in the best interest of their longer term shareholders. I feel sorry for the fools who buy the stock at 21 because it's worth single digits, and I'll have a note out shortly. My target's under review.
Okay, but still, Michael, I mean, we saw Roaring Kitty getting back on X and then that causing a little bit of this rally. I know it wasn't the only cause, but could there be another random catalyst that leads to a GameStop rally that really isn't about the company fundamentals?
Well, with respect to Roaring Kitty, because he was absolutely right in 2020, there was a structural flaw in the holdings of GameStop. I mean, they had more than 100% of the shares short, and he made that observation. It was astute. He rallied retail investors, Redditors, Reddit raiders to buy into the stock, and he was right. And they made a movie about it, and he was right. Now he's not actually doing anything other than posting video clips, and he was dormant for 2 or 3 years. He just started a frenzy of posts, but they're all video clips. Only one had any reference to GameStop. It was a woman with a GameStop logo on her dress. I don't know what he's saying. So sure, guys posting movie clips saying it's over. What's that mean? If you want to buy a stock based on that, God bless you. But he has not actually said, go buy GameStop.
Right. So Michael, what do you think the next several months, several quarters look like here then for GameStop?
They're going to see continued declines. There's nothing big coming out this year. We don't have anything incremental this year. Next year you have Grand Theft Auto, but nothing big. No new consoles this year. The console makers are all kind of guiding to lower expectations. Sony's looking to sell 18 million consoles. They were looking to sell 25 million before. The big news today, which is a Wall Street Journal exclusive speculation that Call of Duty will be on Game Pass. I can confidently tell you that anybody who's a Game Pass subscriber would be an idiot to buy Call of Duty. They won't. So Call of Duty sales will be lower this year. It wasn't on Game Pass last year. And that means physical sales at GameStop will be lower because of that. So lots of headwinds for them, and I don't see any way out of it. The preliminary results were actually worse than we had modeled. They did under 900 million in revenue, and we had modeled $1 billion. That's down 25% year over year. Now, that's not all industry decline. Some of that is store closures, and we don't have the detail yet. But realistically, they cannot save their way to prosperity. Their store unit economics can't get any better. You have to have an employee in the store. You can't leave it at self-serve or people will steal everything. And you can't not pay rent or not turn the lights on. So they're done shrinking their cost structure. The only question is, can they, shrink their store count and return to profitability? I don't think so. They lost money last year. They made 17 million net income with 45 million of interest income. So they lost on an operating basis by over 30 million.
Michael, you mentioned the news that Microsoft is reportedly planning to release the next installment of Call of Duty as a subscription service instead of the usual a la carte model that's according to the Wall Street Journal here. Do you think that that is a game-changing move for Microsoft?
It is. I mean, Game Pass as a subscription service is only worth $15 a month, $180 a year, if you play more than $180 worth of games. So roughly 3 games a year. If you can use Game Pass instead of purchasing 3 games, it's a good deal. That's why we pay, for Netflix. We pay about the same for Netflix, but we watch enough content to make it feel worthwhile. And so Microsoft's just trying to build the content so that they have enough people view the subscription as an attractive substitute for purchasing games. Yes, good for Microsoft in the long run. They won't be making money on Game Pass until they get to around 100 million subscribers, and they're at 34 million. So the only way they're going to get to 100 million is to put premium content on there, like Call of Duty. They own Call of Duty, so it's going to cost them the sales of Call of Duty, which is also going to cost GameStop. And they're just hoping that they get enough subscribers to make up the difference. They won't this year, but they might in 5 years. And I certainly think they will in 10. So they're willing to take some losses while they build the business out.
I quickly want to talk to you about one other name that you cover, which is Beyond. You've got an outperform on it. This includes Bed Bath & Beyond, for anyone who may not know. They obviously had their own issues and recovered to a degree. Is there any evidence that GameStop could follow a similar path as Bed Bath & Beyond?
Well, they could follow a similar path as the bankrupt Bed Bath & Beyond, follow a similar path as Marcus Lemonis led Beyond? No, I don't think so. I had to look the word Stan up. It's a stalker fan. That's me and Marcus. I am absolute Stan. I love that guy. It takes a visionary retail leader like Marcus to turn a company like Beyond around. He's buying up brands. He bought the Bed Bath & Beyond brand, or actually former management did. He bought the Zulily brand, and he's revitalizing the Overstock brand. I love that. I think they're going to be kind of all by themselves and close up merchandise. They're going to be a premium brand for home furnishings and a premium brand for toddler merchandise. I think that GameStop, if they try to reinvent themselves, more power to them. But what's left? I mean, we've already seen Ryan Cohen do Chewy. Is he going to try to sell dog food through the GameStop brand? I doubt it. I mean, for real. And the GameStop brand's problem is that the substitute is not, a different online retailer or a different physical retailer. The substitute is a digital download. GameStop sells something you don't need to purchase physically. Beyond does not. Beyond sells stuff that you're either going to buy at a different online retailer or you're going to go to a physical store to get. You can't digitally download a couch. Just can't happen. So you can digitally download Call of Duty, and Microsoft's making it easier by letting you stream it. So very easy to not make that purchase at GameStop. No, they cannot follow in the path of Beyond unless somehow Ryan Cohen takes his $1 billion cash balance and pays it to Marcus Lemonis and sees if Marcus will turn the business around for him.
All right, Michael, we're going to have to leave it there. Thank you so much for joining us. We really appreciate it. That was Michael Pachter. He is Wedbush Equity Research Managing Director. China is unveiling plans to revitalize its property sector, the country easing mortgage rules and pushing local governments to buy unsold homes to develop more affordable housing. Now, this sending China's property index shares higher in the pre-market here. You can see, though, in the trade here, actually, I should say. But Shauna, taking a step back just to go over kind of what this is, the rescue package is meant to prop up the property market in China, which has really just been in shambles over the past couple of years here. This is the most urgent step that we've seen from authorities. They're going to have about 40 billion US dollars that'll go to state-owned entities to convert empty homes to social housing. And just to indicate kind of the context of how tough the situation has been for housing, we have data overnight from China showing that housing prices fell at their steepest levels in over a decade here. And this makes up about a quarter of China's overall economy. So a really big deal to see that struggle in the housing sector. Last thing I want to bring up is a note that we got from UBS's Paul Donovan this morning. And he was basically talking about this idea that if the growth target for China is met through production, output, for example, rather than domestic consumption, China could be vulnerable to trade reprisals and things like tariffs moving forward. If your economy is based on sending stuff out and then you get a lot of tariffs, that could be a big headwind for China, which then is a headwind to a lot of the companies that we talk about all the time.
Yeah, I think what ultimately the impact that this is going to have remains to be seen, right? There's a lot out there, a lot of strategists, a lot of forecasters saying that clearly they're not out of the woods just yet. I think that is largely the consensus at this point, given the struggles that you had just been highlighting here. But the move, writing $42 billion of funding to buy those unsold homes, it does mark a transition or a difference in the stance that we have seen Beijing take on the property sector here in China. So it certainly is significant. What exactly this does ultimately to prop up the economy down the road, we are starting to see that recovery gain a bit of traction in China. But again, the data continues to be mixed. We did see some pressure on the latest consumer data coming out. And then you take a look at the industrial numbers, actually, and they pointed to signs of strength there. And we're seeing that play out in some of the commodity trading, especially oil, that movement to the upside here that we are seeing today. So again, remains to be seen. Certainly a story to watch here, and more broadly speaking, the impact that this could potentially have on China's economy and that recovery, and what exactly that means ultimately here for the global markets. All right, well, coming up, Boeing's annual meeting is in less than an hour. We will speak to a shareholder of Boeing to get his take on what to expect and what he wants to hear from Boeing. We'll be right back.
Let's do a check of the markets here, sponsored by Tasty Trade. Looking at green across the screen, but just barely. The Dow is underneath that 40,000 level that it hit its all-time high at yesterday. The S&P 500 just flipping above 5,300 here, just barely though, so we'll monitor whether or not that is able to hold on here. The Nasdaq also just barely up here. We've seen not a ton of conviction, not a lot of volume, and also just not a lot of momentum heading into the trade as we kick off the day about an hour, 2 hours into the trade here.
All right, let's talk Boeing, because Boeing's annual shareholder meeting is set to kick off 11 a.m. Eastern time today. One of the big questions being voted on is whether the embattled CEO Dave Calhoun, who will step down by the end of the year, whether or not he's going to be reelected to the company's board. For more on this and what ultimately shareholders want to see happen at Boeing or prioritize here for Boeing, we want to bring in Tony Bancroft, Gabelli Funds portfolio manager and Boeing shareholder. It's great to see you, Tony. So talk to me just about what you think Boeing should prioritize and what you're hoping to learn at today's shareholder meeting.
Hey, Shauna, great to be here. Thank you. I think for priority, my focus as a shareholder in our Gabelli Commercial Aerospace and Defense GCAD ETF, I think would be number one. I know they've got to get through the technicalities of just going through the annual meeting and voting on directors and CEO pay. But to me, the focus is they've got to announce and in place a new CEO now that they've announced that CEO Calhoun is leaving. They've got to get the Spirit deal done with and put in the books. Thirdly, they've got to get the 737 MAX authorization, increased production with the FAA increased to above 38. And then lastly, they've got to get the 787 deliveries, production, and supply chain squared away, and that's what I'd be looking for in the near term.
So I'm curious, Tony, you obviously know that shareholders are voting today on whether outgoing CEO Dave Calhoun should remain on the board. What would your take on that be?
I refer that to our proxy voting committee. But me personally, I have no problem with CEO Calhoun, Maddie. I think he's, actually done a great job. Just remember he took over in the midst of two mishaps, and then obviously on top of that, COVID hit, the worst downturn in commercial air travel in history, and he essentially brought Boeing back from about zero production of the 737 MAX to 38 a month. That's a large increase, and he did a pretty good job. Overall, I have no issues with CEO Calhoun.
Who do you think Boeing should consider, or when you talk about what that past experience should be, who do you think some of those, not naming specific names, but talking about the possible successor, just what that conversation looks like?
Yeah, Sean, I think it's probably got to be someone. Doesn't need to be an insider. It could be, but it's somebody that needs to have a technical background. Boeing at some point is going to have to design a new plane. There will come a time when technology and efficiency is going to outrun the current production aircraft. And I think someone who has that understanding and background to work with engineers is probably a pretty it can be heavily weighted for the decision. At least in my opinion, and I think most probably investors are probably thinking the same way.
Well, Tony, let's just talk about the obvious here. Boeing's had a really rough couple of months here. I mean, my friends, whenever they see a plane issue in the news, they just assume that it's Boeing. How bad is that for the stock? And would that issue for them, the safety issues, ever change your mind on Boeing?
Yeah, it's a good point, Maddie. I think the reality is that Boeing has partially lost the narrative of sort of the reality of what's going on. Right now there's multiple 737 MAX aircraft launching and safely recovering all around the world. And just statistically speaking, the FAA fleet is the safest fleet in the world, and probably the safest form of public transportation in history. We haven't had a crash related fatality since 2009. That's 15 years. That's about 10 to 12 billion passengers traveling safely under FAA's watch. And 51% of that fleet, of that FAA fleet, are Boeing aircraft. So they're by far the mass majority of of what's driving the safety in this country. But with that being said, sometimes perception is reality, and I think the reality is Boeing's just going to have to just keep blocking and tackling, moving forward, and producing safe aircraft, which they have done for last multiple decades, and they'll continue to do going forward.
Tony, when we talk about the future of Boeing, what exactly that's going to look like, the potential acquisition interest here that we have seen in Spirit AeroSystems, I'm curious from a shareholder perspective, does that increase the value here for shareholders? Why or why not? And then there have been some issues raised just about the impact that this is ultimately going to have on the industrial industry, on the defense industry at large. How should investors be looking at that?
I think in the near term, it's going to cause volatility. Obviously, it's going to be a big cost. Boeing's going to have to pay for Spirit. Obviously, they have to get figured out with Airbus of how they're going to deal with the two production plans that produce Airbus components. And then after that, on a run rate, it's probably going to save Boeing about $1 billion a year in cost by owning these businesses. And I think more importantly, it's going to own the culture, and it's sort of going to be one team, one fight. The fuselage is the critical sole source component for an aircraft. You're not going to get two fuselage suppliers, and I think I think it's pretty apparent that the OEM who's producing the aircraft needs to own that component of the aircraft. It's just so critical as far as production, supply chain, you name it. So I think in the long run, this is going to be very beneficial to Boeing, and it's just the right thing to do.
All right, Tony, we're going to have to leave it there, but really appreciate you joining us today ahead of this shareholder meeting. Thank you so much. That was Tony Bancroft, Gabelli Funds portfolio manager and Boeing shareholder. Now, Tesla is reportedly moving ahead with its plans to build a data center in China. It could be used to help develop the self-driving algorithm. That is according to reporting from Reuters. For more, we're going to bring in our very own Praz Subramanian. Praz, this is a really big deal. What do we know so far?
Well, it's actually a bit of a wrinkle here. It's not so much that they're building a data center, it's that they're actually using the data there and they can't bring it to the U.S. Mm-hmm. They had to already have a data center in China per their, the local regulations about data collection. So the key is that Musk wanted to bring all that data from China to the U.S. to train the self-driving AI algo, right? Can't do that. So now, according to Reuters, he's reversing course and said, okay, we'll data center stays here, the data stays here, we'll train the algorithm in China. I mean, it's important because that's where the most cars in the world with the FSD type sensors are in China. You also have a lot of mapping technology. There are a lot of other partners there that can share data. So he's saying potentially, what if we train the algo there in China and then take that information and spread it elsewhere, right? That's sort of like the pivot here. There's some risk there, with dealing with China. You never know when they can lock you down. You never know when they can say, you know what, we're going to stop you here. So it's kind of a risk, but also I think he sees that as an opportunity. They use the Reuters article notes that China Gigafactory became the leading factory there for them, and that wasn't necessarily going to be the case when people thought about them creating that factory there. So maybe China is the push. Maybe China is the angle for where they're going to attack FSD.
Is this a strategy that you think? Do analysts think that it makes sense in terms of Tesla's longer-term goals in trying to increase that widespread adoption?
I think there's two parts, right? I think yes, because it's a big market. It's sort of widely mapped. Other players like Baidu already doing that stuff there, and you can kind of work together with. But the problem is that then they don't necessarily own the data potentially, right? Yeah. Also, there's a mention of how you can't sell these Nvidia chips in China because they're banned. So how do you get around that? They need those chips to build a data center and to train the algo. So. But yeah, I think you're right. There's an opportunity, but also some risk.
Yeah, certainly. It seems like there's a number of risks, and almost like it has to be weighed just in terms of whether or not those risks outweigh some of the benefits that maybe Tesla could see in order to build this. But clearly, a story we're going to keep following. All right, Pras, great stuff. Thanks. Let's take a look at Applied Materials. AMAT, the country's largest semiconductor equipment maker, shares are essentially flat this morning, but we're bringing this up because we're getting data out, the latest earnings report here, and pointing to some larger trends that we want to highlight and what this exactly tells us about the chip industry. So when it comes to what these expectations were, investors were looking at AMAT for signs of whether or not this chip recovery is well underway. Remember that this is a stock, if you actually take a look at a longer term chart of Applied Materials, this is a stock that is actually risen about 30% this year. So these results failing to really live up to those expectations or give investors a reason to buy at these elevated levels. But it does give us a good sense of demand in some crucial parts of the electronic supply chain here. So again, their forecast a bit tepid here. At least that's the view of some investors and analysts at this point, Maddie.
Yeah, it's interesting seeing some of the commentary that we're already getting in after this update from AMAT as well. Morgan Stanley's analyst Joseph Moore saying he reiterated his equal weight rating, saying that the forecast is conservative around China spending next year. Again, China spending continuing to come up across a lot of these prints. He said that they're impressed by their execution, but they don't see an imminent negative catalyst with the China spending, but still something to watch because it was a little bit conservative there. Again, those sales in the third quarter could remain flat, essentially, given what we already know from them. And it just continues to be another name that is impacted by China spending on chips in particular. But interesting to see whether or not that is going to be able to normalize a little bit, particularly as the situation in China potentially normalizes after that government intervention there. And looking at cannabis stocks as well, they're in the green this morning after the U.S. Department of Justice officially unveiled their proposal to ease restrictions on marijuana. Under the proposal, cannabis would be reclassified from a Schedule 1 drug to Schedule 3. Now, just to remind people, Schedule 1, some of those drugs, cocaine, fentanyl, I mean, really intense drugs here. Schedule 3, a much more moderate schedule, signifying that the drugs in that category have a low potential for physical or psychological dependence. Some of the other drugs in that area include the likes of Advil, so much. It's a really big deal. It's a huge shift. Now, we did see some of these cannabis stocks moving to the upside, but they are still well below their 5-year highs. A company like Curaleaf is still down 66% from its highs. Tilray, we've spoken with the CEO together, Shauna, down nearly 97% from its highs as well.
And there is some talk about whether or not this is a deal or a move that is being done before the election because it could potentially win the favor here of especially the younger voters here for President Biden. We know President Biden yesterday endorsing this. We did see some of that excitement play out when you come to the cannabis stocks and the movement that we saw to the upside here yesterday, saying that they are going to treat this. He's going to treat this marijuana as a less dangerous drug. Now, it's important to point out that this isn't going to legalize weed, though, under the federal law, right? Only Congress can do that. But again, it is giving investors a reason to buy. We did initially see the excitement when this report was initially released. We've talked to a number of these cannabis CEOs talking about the fact that this is largely viewed as a massive step in the right direction. Clearly, more reform needs to be seen in order to have a massive catalyst here for these stocks, but it is enough for many of these names to catch a bid here in early trading, catch a bid yesterday, and that's what we're seeing play out when you take a look at the stock action today.
Well, we're going to have more of your markets action ahead, so stay tuned for all of that and more. You're looking at gains across your screen. The S&P just above 5,300, but the Dow still below that 48,000 level. Keep it here for more. You're watching Catalysts.
Originally inspired by General Motors ending its EV1 program, Tesla has become the world's leading electric vehicle manufacturer. In 2023, Tesla generated nearly $97 billion in revenue, and its market cap is over $570 billion. The company was Yahoo Finance's top trending ticker of 2023, with over 300 million page views. Let's take a look at some of the company's biggest moments with Beyond the Ticker. Originally named Tesla Motors, Tesla was founded in 2003 by Martin Eberhard and Mark Tarpenning. Elon Musk joined the company in 2004, investing over $6 million of his own money and becoming chairman of the board. In 2006, Tesla unveiled the prototype for its Roadster, which entered production in 2008. It was the first all-electric car to use lithium-ion battery cells. After co-founders Eberhard and Tarpenning left the company, Musk took over as CEO in 2007. On June 29, 2010, it went public via IPO on the Nasdaq at $17 per share. In 2016, Tesla unveiled the Model 3, its first mass-market vehicle. Later that year, Tesla agreed to acquire SolarCity for $2.6 billion. On July 6, 2017, Tesla's stock crashed after delivery concerns. The company lost more than $12 billion. Defying expectations, Tesla recorded 4 profitable quarters in a row from 2019 to 2020, making it eligible for inclusion in the S&P 500. On November 4, 2021, the company reached an all-time high stock price of $409.97. Originally introduced in 2019, the first Tesla Cybertrucks were delivered to customers in November 2023. Tesla continues to produce despite its setbacks due to lawsuits, manufacturing delays, and Musk's controversial statements. Investors will continue to wait for the next wave of innovation from the world's most valuable automaker.
Netflix's surprise 3-year partnership with the NFL is marking a major shift into live sports programming, or live programming in general here for the streaming giant. For how the street is interpreting this deal, what ultimately this means for Netflix, Yahoo Finance's very own Alexandra Canal is here. And Ali, I know you've been speaking with a number of analysts. Just give us a better sense of how they're viewing this deal and whether or not, how big of an opportunity this is for Netflix.
By and large, the reaction on the street is very positive, especially considering sports has been considered the last frontier of the streaming wars. However, there are some on Wall Street that say that this might be more of an experiment for Netflix, really testing the waters to potentially bid on on more live sports down the line. Jason Bassinet from Citi told Yahoo Finance he doesn't necessarily think the NFL will help Netflix retain loyal subscribers over the long term, but that it's still a good thing and a natural evolution of the industry. JP Morgan, meanwhile, argued that the games will offer a boost to Netflix's ad tier, and that seems to be the driving story here, that it's going to be a great opportunity for advertising and will also deepen Netflix's relationship with the NFL. The analyst Doug Amiff also said that the deal terms are attractive. Now, Netflix has not revealed any specific figures, but Bloomberg has reported that they are paying less than $150 million per game. And that's actually less than what they've spent for some of their original movies like The Gray Man, for example. And considering the NFL has such a large built-in audience, that is attractive at the end of the day. And really what it comes down to is that live sports, live events in general, we've seen them really double down with live comedy events. There's a stickiness there. There's this on-demand appointment viewing. And if you have that element, you're going to attract subscribers. And hopefully once they're there, you can keep them there longer based on the content that you already have on the platform. And that's what we're really seeing across the board. Netflix has pretty much shied away a little bit from the live sports game, but now we're seeing them really dive right in with this NFL partnership.
Well, I know in your reporting you highlight the number of games that Netflix has compared to the other ones. It's like a really tiny percentage, obviously. I wonder, is there a world in which people end up being like, I don't even know where to find my NFL games, and then that ends up being a headwind, or do they have the marketing budgets that that's not really going to be an issue?
Listen, from the consumer perspective, this isn't ideal. And I do think over time, that's why we're seeing all these bundled offerings, right? I think we're going to eventually see more consolidation in this space. But the NFL has several partners. You're seeing those on your screen right now. And Netflix only has 2 games, but they're one piece of a very large pie between broadcasters and streaming giants. Now, the NFL, the NBA, all these major leagues, they want to get as much money as possible. And they're realizing that if they can siphon off certain games, they can get a large amount of money for those specific games and have them as exclusive offers on these different streaming services. So as a consumer, you're going to have to pay a heck of a lot more money than you're used to paying in order to watch every single one of these games. And that doesn't create the best user experience.
I'm curious, Ali, from your reporting and from who you've been speaking with, the experts within this area, how sticky are the customers who maybe do try out some of these services just for the games? Have we seen data on that yet, or is it still a bit too early to really figure out what that traction level looks like?
Well, Peacock did host an exclusive NFL game last season, and they did see a bump in their Peacock subscribers, and most of them did stay for the duration. So I think we're still a little too early to know if that can be replicated across the board there. But again, it all comes down to the type of content that you have on your platform that can keep people there. Obviously, there's a new season of Bridgerton out. I am a big Bridgerton fan. So, as someone that is a fan of those types of shows, sure, if you can get them on the platform for a live event and then they can stay for some of your other scripted content, that's great. But there's also a lot of competition right now on the market, and that's really where all this is coming to a head. So we'll see if this is just cyclical. We'll see if this is the norm, that these live events are just going to be receiving a lot of money. And we know sports rights in general, the value of those have ballooned. But for now, Netflix is getting into the game.
I forgot that Bridgerton was back.
Oh yeah, I watched the first episode last night.
I mean, that's the weekend.
I know.
Yeah, it
back
is
with the rain.
But they're doing it in 2 parts, though.
I know.
So you can't fully binge it. But
Which is the strategy that they've been doing now for some time, right?
There you go. All right, Ali, we could talk to you forever, but the producers are yelling at me. Thank you so much. Really appreciate you as always. Well, Nvidia shares are surging so far this year, up over 90% year to date, and investors eagerly awaiting those first quarter results coming up next week. Here's a look back at the company's rise.
From creating graphics cards for gaming to becoming one of the world's leading AI chip companies, it's safe to say Nvidia is officially one of the tech giants. In 2023, the company generated nearly $27 billion in revenue, and its market value is well over $1 trillion. Let's take a closer look at what led to Nvidia's boom with Beyond the Ticker, where we dive into the company's biggest moments. Nvidia was founded on April 5, 1993 by Jensen Huang, Chris Malachowski, and Curtis Priam, with a vision to bring 3D graphics to the gaming industry. In 1997, Nvidia launched its first hit product, the NV3. It would later go on to sell a whopping 1 million units in its first 4 months of availability. On January 22, 1999, Nvidia went public via IPO at $12 per share. And in 2000, Microsoft chose Nvidia to develop the graphics hardware for the first Xbox console. 5 years later, Microsoft's rival Sony chose Nvidia's hardware to power the PlayStation 3. In 2010, Nvidia became the graphics chip supplier for automaker Audi. And in 2015, the company launched its Nvidia Drive chip for powering driver assistance technologies. In 2016, Nvidia kicked off its AI efforts with the launch of the DGX-1. 2 years later, the company debuted Nvidia RTX, the first GPU capable of real-time ray tracing. That same year, Google announced it was using Nvidia's Tesla P4 graphics cards for its Google Cloud platform. In 2022, Nvidia debuted its H100 graphics chip for AI, which still stands as one of the world's most powerful chips for artificial intelligence apps. And in May 2023, Nvidia eclipsed the $1 trillion market cap mark, joining the ranks of mega companies like Apple and Microsoft. The stock continues to surpass its all-time highs over the past month and is currently trading at over $700 per share. From a company of 3 engineers working on graphics cards to thousands of employees working on chips that will power the AI supercomputers of the future, Nvidia remains at the top of the tech industry.
Stocks are poised to end the week higher. All 3 major averages hovering near their record highs. The S&P 500 just above the 5,300 level. The Dow just under that 40,000 level. But the star of the show this week is the Dow, briefly passing that critical 40,000 mark on Thursday. So we want to zero in on the big names that drove that rally. The stocks that doubled the Dow since 2017. Among the winners, Apple at the top, United Health Group, Microsoft, Caterpillar, and Goldman Sachs. These are really the names to watch much because of the degree to which they drove this rally. But having said that, Shauna, the Dow is like such a funny little index because it's more of an average of prices rather than it doesn't weigh things correctly, one could argue. And the company weightings in the index are so different than their market cap. So when you look at a name like Apple having a lower weighting than Home Depot, that's just weird.
Yeah, certainly. It's interesting to point out. It's important to point out, and I think that's why so many investors really were talking a lot about the S&P and the movements that we're seeing there versus focus specifically on the Dow and the Dow components, which obviously a shift going back many, many, many years. But I think that when we talk about 40,000, the level of 40,000, that milestone, what it means psychologically, I think there is reason to be excited about it. Clearly, my takeaway from the conversations we have been having with so many strategists here at Yahoo Finance over the last week is, hey, when we are at the levels that we are currently at, when valuations are as high as they are, yes, we are due for a pullback, right? It's not exactly going to be just up and away from here at these levels with the Dow at 40,000, with the S&P right around 5,300. But there is still reason to be optimistic just about what that action could look like between now and year end. So maybe we should be ready for a pullback. We could get a pullback around 5%, but then we also could reverse and trend higher. And that's actually viewed as being healthy here for the market. So my takeaway is that, yes, there's a lot to be excited around when you talk about 40,000. There's also reason to be a little bit hesitant or questioning the current levels, the current valuation, viewing a potential pullback as healthy here for the broader markets. And then ultimately, like Brian Belsky, where we started the show saying, there's reason to think and reason to believe that we could see the S&P hitting 5,600 by the end of the year.
5,600 hats. Get them ready. All right. Well, coming up is Wealth, dedicated to all of your personal finance needs. Our very own Brad Smith is going to have you for that during the next hour. So stay tuned.
Welcome to Wealth. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. On today's show, housing hurdles. Mortgage rates are coming down, but maybe not fast enough for many people. An expert will bring you the tips and the tricks to pay down your mortgage. And pain at the pump. We're tracking gas prices ahead of a busy summer travel season, so listen up there. Plus, money in the bank, or as T-Pain would say, money in the bank, will bring you the investment strategies to deal with what one financial advisor calls a global savings crisis. All that and much more, and plus more singing during today's show. But let's kick things off with a check of the markets. Stocks higher after the Dow pushed about 40,000 and hit 40,000 in intraday trading, but it failed to close at that milestone figure on Thursday. Here, you're taking a look at the Dow right now. Just below that, right now we're flat, but just barely to the upside by about 0.09% here. The S&P 500 flat, but barely to the upside, as well as the Nasdaq there on a percentage basis flat. So we will see how we continue to navigate today's trading activity this Friday. We are just days away, though, from one of the most anticipated earnings reports of the season. Wall Street's darling, Nvidia, will be reporting its Q1 report on Wednesday. And to break down Nvidia's meteoric rise and what to look for in this earnings report, we've got Yahoo Finance's very own Julie Hyman here in studio with us. Hey, Julie.
Hey, Brad, there'll be no singing from me, but I look forward to more from you. I just want to set up a little bit first why Nvidia is so important. Remember, this is a chip-making giant. It makes so-called GPU graphics processing units that have become really integral to this explosion in generative AI and the data processing that is needed to train AI models and then power them as they operate. This has meant that Nvidia has really climbed in importance in weighting in the S&P 500. It is now the third largest company by market weight in market cap in that index, and it's a market-weighted index. So the third biggest stock in the S&P 500 behind Microsoft and Apple. Nvidia now $2.3 trillion in market value. You see here Alphabet and Amazon are even smaller when you look at that market cap weighting. And how did it get here? Well, if you look at the charts for the company here is a look at the Nasdaq 100 year to date of the various stocks. And Nvidia, if you look at the year to date chart for this company, it's up almost 90%. This is after its 240% climb last year. So it just keeps going up and up and up. That means that it's gotten to that market cap level where it is today. And to look at it another way here, the market cap over time, which has just sort of exploded in the past few years. It's exploded alongside the revenue growth for the company. Going to back up just a bit to see if we can find that revenue chart. There is that revenue chart here. So you see the enormous growth that we have had in that revenue over the past few years in the triple digits after sort of hovering at the same level for 21, 22. What is so extraordinary about this, to just put a fine point on it, is companies, when they get this large, it is very rare, if not unprecedented, for them to grow at this level. To just give one example here, John Vinn over at KeyBank expects that data center revenue alone for Nvidia will reach $200 billion in calendar 2025. That will be a 321% gain from 2023. So a more than 300% gain in just 2 years to $200 billion. Just to sort of compare it to what we have seen from other companies, usually companies that grow at that rate in terms of sales are very young companies. Tesla, for example, back in 2013, it grew revenue by 387%, but its revenue was just over $2 billion. Compare that again with just the data center revenue of $200 billion expected for this company. Just a few years ago, yes, Nvidia was known for AI, but it was mostly known for graphics chips for video games and also for crypto miners. And in fact, it was the company of the year back in 2016 here at Yahoo Finance. I wasn't even aware of that. I wasn't here in 2016. And, back in 2016, here's the revenue right around there. So it's pretty fascinating how much it has grown, even as it is so large. Brad, it's been a fascinating story.
It absolutely is, and it's become even more fascinating, going to become even more fascinating next week. So what can we actually expect from the earnings report for this quarter?
So if we take a look at what analysts are expecting for earnings, they're expecting a lot of really incredible growth here. So $5.54 in adjusted earnings per share, $24.6 billion in revenue. Again, most of that is going to be data center. And many of the analysts had said there was some concern that there would be a sort of pause in demand for Nvidia's chips. It's now selling its Hopper suite of AI chips, but it's introducing an even more advanced suite of chips and software later this year called Blackwell. There were some questions. Would customers hold off on their orders for Hopper chips while they're waiting for the Blackwell? And most of the analyst commentary I've seen has said, no, they will not, because they'll be concerned that they can get their hands on the next generation of chips, so they'll keep the orders that they have. All of that said, with the stock up almost 90% this year, Brad, many of the analysts are questioning the further upside and pop it could get from this particular earnings report because expectations are so high. And of course, the focus is very much going to be on the forecast for the coming quarter and the second half of the year.
All right, their eyes were watching NVDA next week here. Julie, thanks so much for teeing up what we're going to all be keeping close tabs on next week. Plus, turning now to the state of the housing market. Mortgage rates decreased for the second consecutive week, but the 30-year fixed still holds above 7%, where it's hovered since mid-April. So what does this mean for new home buyers out there? Joining us now, we've got our very own Rebecca Chen. Hey, Rebecca, what do we know here, and what's the weight on some prospective buyers out there?
Hey, Brad, thanks so much. So this week, we saw mortgage rate, like you said, getting closer to the 7%. It dropped to an average of 7.02 for the 30-year mortgage fixed rate. On the daily tracking, we actually saw mortgage rates drop even in the 6% range. So we are starting to wonder that if we are seeing a downward pattern for mortgage rate that everybody has been talking about since the beginning of the year. Aside from just tracking this mortgage rate and how it's whether it's heading up or down, we also been tracking how home buyers are reacting to these mortgage rates. And what we saw this week is that even though rates has been dropping for 2 weeks straight, there hasn't been that much home purchase application on the market right now. And what that's telling us is that home buyers are still not convinced or not motivated to come back to the market because financing cost is still too high for them. Just to put everything into context again, right now at around 7%, we are more than double the mortgage rate cost than 3 years ago. So what home buyers are paying today in terms of to their bank is a lot higher than they would be in 2021 when rates were around 3%. So definitely we are seeing a little bit more activity and a little bit more drop in the mortgage rate, but there just hasn't been enough of it to entice more buyers to come back to the market. And then I think what this really tells us is that first-time home buyers, or really any buyers, are highly sensitive to today's rate. And given that it's been very volatile, going up and down every single week, we are seeing that this has a huge correlation to what buyers can afford today.
And so with that in mind, Rebecca, and with also the caveat that this is largely hinging on the Fed and what they do in the coming months, when could we see rates coming down?
That is the million question right now, Brad. To be honest, nobody knows when mortgage rate is coming down. One expert even told me that mortgage rates are famously known for being hard to predict, and we can definitely see that right now because I feel like every week when we talk to experts, they think it's going to go one way, but it ends up going another. So it's hard to tell where it's going to come down, but what I can say is this. Given what has been happening with the Fed, with the inflation data and CPI, most experts are saying that rates will probably fall further from today into the 6 to 7% range for the remainder of 2024. What this means is we will see some kind of rate cut later on in the year, and that will bring mortgage rate down for home buyers. And I did kind of want to talk about a little bit about what everybody we've seen across different financial institutions. Fannie Mae, the NAR, Wells Fargo, all these financial institutions, they changed their forecast recently from the beginning of the year. And all of them upward revised their forecast on mortgage rates. And when I talk to them, they say it's because they just see inflation being so stubborn and the possibility of Fed cutting rate anytime soon is getting smaller and smaller. And that is why everybody is upward revising their mortgage rate today. And what this means for housing market. I think that's probably what all the home buyers are wondering right now. What can this mean if it's 6 to 7% and if rates are being cut later? Essentially, what it really means is that you could have, when this happens, you could have a smaller financing cost, but it probably won't do much to the housing price because we are still in a shortage. We still see a huge shortage of inventory supply on the housing market. And inventory shortage is what is driving prices the most right now. So all that being said, there's still a lot of uncertainty in the housing market, but we'll be tracking mortgage rate very closely every week.
All right, Rebecca, thanks so much. Teeing up this next conversation as well for us here. In high inflation, interest rates, it's a double whammy for your fanny here. It's weighing on homeowners out there, and the delinquency rate for mortgage loans on 1 to 4 unit homes. That increased to 3.94% of all loans outstanding at the end of the first quarter of 2024. That is up 6 basis points from the fourth quarter of 2023 and up 38 points from a year ago. That's according to Mortgage Banker Association's National Delinquency Survey. So, in this economic environment, how should you go about paying off your mortgage? Joining me now is Michael Roberts, University of Pennsylvania, the Wharton School Professor of Finance. Great to have you here with us. First and foremost, I mean, there are some people out there that just say, if they have the means, should I just pay this entire thing off right now? And what are the pros and cons of doing that?
Well, great to be here with you, Brad. So it's really a question of whether or not it makes financial sense to pay off that mortgage. So there's some steps or a train of thought by which consumers can go through to determine whether or not they should use extra money to pay down that mortgage. Beginning with, is this my highest cost debt, right?
That's the great beginning point. I mean, there are a lot of people out there that are trying to think about the tips that they receive often for paying down a mortgage. What are some of your top tips for having a strategy for paying down the mortgage?
Okay, so let's try and just break it down real simply. First, what I would do is I'd rank my debt by cost, because we need to think about paying off a mortgage in a broader context. So think about all the debt you have, credit card, auto loan, student loan, as well as your mortgage, and rank it from high to low. So that's the first thing you need to do. The second thing you need to do is figure out, what can I earn safely on an after-tax basis in terms of investing? Because what we're really thinking about is we're taking every extra dollar and asking, should I use this to pay down debt or should I invest it? And if I can earn more investing it, and I should do that. So if I have a mortgage that's 3.5% that I got 4 or 5 years ago, and I can earn 5.5% on treasuries, I'm not so sure, even on an after-tax basis, it makes a lot of sense to be paying down that low-rate mortgage. On the other hand, it's 7% today. I'd try and get rid of that as quickly as possible. Again, after I take care of higher cost debt, namely credit cards, auto loans, and possibly student loans.
What if there are homeowners that are thinking about when the Fed starts cutting rates, if there's going to be the opportunity to refinance, and then they're looking at a different type of regular payments that they could be making to pay down their mortgage? Should people be waiting for that?
Brad, I just don't think consumers should get in the habit of trying to time interest rates any more than they should get in the habit of trying to time the stock market. Look, I mean, the Fed committed to 3 interest rate cuts this year just 6 months ago, and now that's coming under question. So I'm not sure it's in consumers' best interest to be strategizing about where future interest rates are going to be. Rather, just focus on that simple trade-off between where is my money best spent, paying off high interest rate debt or earning a higher rate of return, again, assuming that that rate of return is safe, because you have to pay off your debt. The stock market doesn't have to pay you.
Certainly. Just lastly, while we have you here, how does age factor into the decision to pay off mortgage?
Yeah, so that's a great question, because once we get older, as I'm experiencing myself, right?
All of us are, Michael. It's inevitable.
I know, don't remind me. Once we lose that labor income, right, then debt becomes much more precarious. So trying to pay it down gradually over time and getting rid of it as we move into our retirement years is definitely a good strategy. The question is, how quickly do we want to pay it down? And remember, if you have all your wealth locked up in a house because you paid off your mortgage really quickly and you didn't save, that's very risky, right? All your wealth is tied up in a highly illiquid asset, a highly illiquid risky asset. And God forbid you have an emergency where you need some cash. It's very hard to extract money out of a house. Much easier out of some sort of liquid investment like bonds or stocks.
Michael Roberts, University of Pennsylvania, the Wharton School Professor of Finance. Great to have you here with us today. Thanks so much.
Thank you.
Certainly. Coming up, everyone, your gas, your wallet. We'll dive into what you can expect to pay at the pump this Memorial Day weekend upcoming and throughout the summer. Stay tuned. Let's do a quick check of the market sponsored by Tasty Trade. You're taking a look at them here, but we've got them blown up for you full screen now as we're taking a look at the Dow right now. It's about 100 points below that 40,000 marker, which we were able to touch intraday yesterday. Didn't quite close there. However, hey, there's still a fighting chance. There's always today and next week. And as time goes on, even more time. Anyway, Dow Jones Industrial Average flat, just barely to the upside. S&P 500 is also flat, barely to the upside. And the Nasdaq Composite. Stop me if I sound like a broken record. It's up 0.04% right now. Gas prices are expected to rise this summer by about 10 cents per gallon amid falling refinery capacity and higher refining costs. That's according to new data from the Energy Information Administration. So, What will this mean for drivers in the weeks and months ahead as we get into the busy summer travel season? Joining me now to discuss, good friend of the show, Patrick DeHaan, who is the Gas Buddy head of petroleum analysis. Great to see you, Patrick. We want to use specifically on this topic because people are trying to figure out, okay, what should we be expecting as we're hopping in the car, packing up the family, and getting ready to go to wherever we decide to go to get some R&R?
Well, thanks for having me back. And as you mentioned, the EIA recently revised upward its forecast for gas prices this summer. I would take the underside of this bet, however, the EIA predicting a jump of 10 cents to about $3.70 a gallon. I would point out, though, that we hit $3.69 about a month ago now. We've actually seen the national average fall 10 cents as we approach Memorial Day. Yes, Americans, it can happen. Gas prices coming down ahead of the holiday. I don't think we'll see an average of $3.70. I will point out, though, there certainly is risk in the month of August. A major hurricane certainly could impact prices. But for now, I'm expecting average gas prices this summer to stay probably in the mid $3 a gallon range. The exception, of course, the West Coast. California should see prices falling back below $5. But I think for the rest of us, it's going to be a eerily similar price at the pump this summer compared to what we saw last year.
You know, I know that you're not a climatologist, but you just mentioned something really interesting there, Patrick, which is, of course, the give and take or the relationship between the weather systems and gas demand as well. What are the anticipations there?
Well, it certainly could be a very busy one. At least that's what those forecasters tell us. Colorado State University and the National Weather Service both indicating it's going to be a very busy hurricane season because of El Nino conditions. In fact, Colorado State University puts the odds at about 40% of a major storm entering the Gulf of Mexico. Of course, that would be very bad news. Many of the nation's largest refineries, of course, not only hit by severe weather last night, but a lot of those lie between Houston and New Orleans in Louisiana and Texas. So any major storm going into the Gulf of Mexico certainly would be bad news. I would mention the peak of hurricane season. It does take a little bit of time for hurricane season to reach its peak. That usually happens in August. And that's why for the month of August, our projection is that we could either see prices lower in August if supplies continue to build, or we could see a brief blip if we do see a major hurricane. It is still possible that the national average could jump close to $4 in a worst case scenario.
When people are typically booking air travel, they're always told or frequently told, hey, yeah, book on Tuesdays because that's the time where you're going to get the most deals. It's not the same that you can apply to when to fill up the tank. But if there are tips or tricks that people can lean into to try and mitigate some of the costs at the pump, what could they be?
Yeah, there's a lot of those tips. Things like driving more fuel efficiently certainly can increase the amount of miles you get out of every tank. When you have to fill your tank, making sure you're getting the best deal. Apps like Gas Buddy, Google, or Waze will point you in those right directions. Being mindful of state lines for those traveling on longer road trips this summer. Those state lines are basically danger zones for gas prices. I just traveled down to Mississippi a couple of days ago. Traveling out of Illinois into Kentucky, you'll see gas prices basically fall 30 to 40 cents. Things like routing your trip, certainly using Google to map a more efficient route. There is a fuel efficiency route that they do have in their app. And when you pay for that gasoline too, after you find a good price station, checking out if there's a free loyalty program, things like fuel rewards. A lot of stations have those loyalty programs that roll back your price. So there's a lot of different ways. Nobody should be paying what that street sign says this summer.
And just lastly, while we have you here, Patrick, because there are a lot of the superstores that will have their own rewards programs as well with gas stations annexed. Is there one that's winning that battle versus others?
Well, you know, certainly what some of the wholesale clubs stand out, Costco in particular, they do a real great job with an aggressively low gas price to get people to their location. But there's not really a whole lot of other standouts, right? Costco often has a very low everyday gas price, but even that has been shrinking a little bit in the last couple of years. I would say that there's a lot of loyalty programs out there from fuel rewards, BP, a lot of the major oil companies have fuel rewards. You mentioned the supermarkets as well. Kroger have loyalty programs. They team up with Shell, I believe, in some instances. I would just employ a lot of folks to go out there and make sure if you're buying groceries, there's certainly the opportunity whether you have a loyalty program or a credit card that will give you rebates or rewards. There's a lot of ways out there to reduce what you're paying at the pump.
Patrick, always a pleasure to see you. Thanks so much for hopping on with us.
Thanks for having me.
Some valuable information for travelers out there. Patrick DeHaan, who's the Gas Buddy head of petroleum analysis. Great to see you. Coming up, everyone, our next guest says that we're in a global retirement and savings crisis. Yikes. But don't fear. We're going to bring you the strategies that you need to avoid the pitfalls. Coming up. When it comes to saving for retirement, Americans are feeling pretty pessimistic. An overwhelming 79% of Americans say that our nation is facing a retirement savings crisis, according to a survey conducted by the National Institute of Retirement Security. So, how can we defy this trend? And what are the strategies that you need to avoid the pitfalls? Here to weigh in, we've got Sue Crotty, who is the Seagull Marco Advisors Chief Investment Officer. Great to have you here. So a lot of people are just trying to figure out why. Why are we in this retirement savings crisis right now? Are there some reasons that you've been able to summarize and point this back to?
Yeah, a couple, Brad. As everybody knows, we probably can't retire on Social Security alone. So we need some sort of way to save for retirement. The two most popular ways, obviously, being a defined benefit plan, or the more popular in terms of the numbers and the assets, the defined contribution world. Just a couple of stats. The lowest paid 25% of workers have access to a DB plan, about 8% of people, and to a DC plan, about 45%. Of which less than half of those will actually participate in the plan. And even if you go up to the highest 25% of people, its DB access is about 40 and much higher on the DC side, 70+%. But again, here only 63% of them will participate. So, the latest numbers I've seen from Mabry was, an average 40-year-old who has a DB or DC plan has about $38,000 saved for retirement. And the average across the entire population, which, 1.2 plus million people, is about $70,000. So that's not going to be enough for anyone in retirement to try to maintain their standards of living.
Certainly.
So what do we do about it is the real question.
Right, and that's part of the next question here. How do we get to a point where we begin to make meaningful improvements and claw our way out of the retirement savings crisis?
Some of it is in plan design, automatic enrollment, automatic escalation, those sorts of things. If you have access to a plan, certainly know that is the way to build wealth. There are a lot of new proposals coming out in terms of creating access to retirement plans. Small businesses right now, which, employ, close to 50% of workers, 70+% of those don't have retirement plans. So that's an area where we really need to try to figure out solutions. The Secure Act did come up with some ways to help access and lower costs of offering some sort of retirement plan, but it's in its infancy and it really needs to be pushed in order to gain broader access across a larger population of our country.
For a lot of retirees or planned retirees, all of us plan to retire. So all of this considered, one of the major things that it was a part of the thought process for decades at this point was, hey, you're looking to retire, you go to a warm weather state, maybe you go to Florida or something like that, and you just kind of chill out down there on your retirement, on your Social Security. It seems like the equation is changing drastically, and are there other states that are also trying to make sure that they are making it more livable for retirees?
Yeah, as I mentioned, there's lots of different new plans that are being thrown about and discussed, and some being implemented. A lot of statewide plans are coming into effect at this point in order to try to enhance people to put some money away. And those vary state by state. And, I couldn't even start to go through the wide variety and amounts. And, but it's, it's easily accessible if you just Google your state retirement government plan. That is one way. Roth IRAs are another way. And, part of the problem is that it's just not in the nature of many people these days to put that extra dollar away. It's why I started with saying retirement plans are the best way to try to build wealth. It compounds tax-free. It comes out when you're theoretically at a much lower income rate in retirement. So when you have to take money out, a defined benefit plan, which for a long time in this country was the single biggest and easiest way to put money away, is now just a very small fraction as DC has taken over it. For DC plans, making sure that you maximize a company match is a very important thing to think about.
Yeah.
I talk to my kids about this all the time. It's giving money away if you don't actually put in enough to get that company match.
Yeah.
So those are all ways you should be thinking about it as you look at, and it's never too early.
Absolutely.
Even if you put the minimum away, if it compounds over the next, your 20-year-old over the next 45 years, you're going to have a decent amount of money, and you won't miss that $2 out of your paycheck.
No, I haven't yet. Sue, thanks so much for taking the time here with us today. Sue Crotty, who is the Segal Marco Advisors Chief Investment Officer. Appreciate it.
Have a good one.
You too. Coming up, everyone, with credit card balances at an all-time high, could personal loans be an option for you? We're going to go over some of the pros and cons for those who are loan curious next. Wednesday's CPI report showed that while the pace of inflation may be moderating, consumers are still feeling the pressure on their wallets. One area that this is showing up in, credit card debt, where the average debt per borrower, $6,218. There you're seeing it on screen, up 8.5% from last year, 2023, according to TransUnion. For more on how consumers are dealing with their debt, we welcome in Dan McKeely, who is the Discover Personal Loans Vice President. Okay, so why is it that we're seeing credit card debt pile to this level here? What are some of the leading factors that you can point back to?
Yeah, Brad, thank you for having me. So you said it, inflation, I think, is the primary cause. Discover Personal Loans did a survey last year, and the top reason for consumers feeling stress was inflation, 58%. And as a result of that inflation, they're seeing higher prices in pretty much all areas of their life. And in some cases, they're using debt to finance it.
And so with that in mind, I mean, we're starting to get into the conversation now of, okay, if someone has this debt that is mounting up, where do they need to start thinking about loans in order to pay down some of that debt? And what should the evaluation be there?
Your earlier guest was talking about the different rates that they might have on different types of debt. I think the same applies here. Credit card average APRs in 2023 were at 23%. That is up from 16% during a period of the pandemic. And so by comparison, a personal loan could offer them the opportunity to refinance that debt as low as 6.99% if they have outstanding credit. So there's an opportunity for substantial savings if somebody has great credit and they can roll that higher cost debt into something with a lower fixed rate payment.
Is there a general rule of thumb for a percentage improvement that a person should be looking for when they are consolidating debt?
I don't know that there's a specific percentage improvement. One of the great things about a personal loan is that you can check your rate without impacting your credit report. So you can explore your options. And I think options are a consumer's best friend, especially somebody who's trying to manage their debt. So I would encourage somebody who thinks they might have a savings opportunity to go out and figure out what rates they can actually earn, explore their options for payments and rates.
Are there some tips as well that you've been able to kind of have in terms of the relationship between Discover Financial and its customers on how to pay down debt, but also where to stop spending maybe? Because that's part of the other equation, making sure that you're not racking it up on a continual basis.
Yeah, that's right. Everybody needs a budgeting strategy. The 50-30-20 rule, 50% towards needs, 30% towards wants, 20% towards savings is a very popular strategy. Also trying to increase incomes. But those are difficult things to do. And so making sure that you're getting the best price you can on your debt is something that sometimes people overlook. So what I would suggest is going out there, exploring all options, having a good strategy to manage the spending is of course top of mind, but going out and looking at any opportunities to refinance that at a lower rate.
Our producers probably hear me ask this all the time, and they're about ready to throw a stapler at the control room monitor when I say this, but we've seen the way that the consumer is described change so frequently and recently over the past year, from the consumer is resilient, then to the consumer is healthy, now to what we're hearing from some of the retail CFOs and C-suite saying that the consumer is relatively stable here. If the consumer is spending or tapping or swiping the credit card at this frequency, what does that tell us about the state of the consumer from the Discover perspective?
I think we saw earlier, as you mentioned, the Bureau of Labor Statistics Consumer Price Index is better than it was in prior months, but that's of little relief to consumers. So they're still seeing the effects of higher prices. That's what it tells us about the state of the consumer. Typically, they would prefer to avoid debt. I don't think that people are in a situation where they're managing debt should be ashamed of it. They need to be able to have that conversation open and honestly and try to get themselves out of it. There are some positives here. We know that 80% of customers who take a personal loan to consolidate debt report that they feel less stressed about their financial situation. So there are ways to manage their debt better and meet their overall financial goals.
Dan Nickley, who is the Discover Personal Loans Vice President. Dan, thanks so much for taking the time here on this Friday.
Yeah, thank you, Brad.
Absolutely. It's a good practice to try and pay your credit card on time, but what happens if you don't? Joining me now in studio, we've got Yahoo Finance contributor Ross Mack. All right, in the event somebody does not pay their credit card on time, what should they expect to happen?
Well, one, I don't want to be a Debbie Downer, right? Listen, obviously we understand you want to pay your bills on time, but some people are carrying the balance, are actually failing to do that. And when it's all said and done, it's going to impact your credit score, right? At the end of the day, we're talking about what makes up your FICO score. Paying your bills on time is 35% of that. So literally missing one payment is going to have a significant impact on your score. It can go down about 100 points at max, right? But not only that, it's also going to stay on your credit report for up to 7 years. So now let's actually talk about what happens when your credit score is impacted, right? It's going to impact any other future credit worthiness when it comes to whether it's auto loans, home loans, personal loans. And guess what? What's even crazier? Some jobs are actually want to run your credit score.
Really?
Some jobs will literally run your credit score, and they might say, hey, if this person not paying their bills on time, guess what? They're probably not showing up to work on time, right? I probably can't actually, trust that person. And another thing is, right, financially, right, there are a lot of other ramifications, right? Obviously, higher interest rates you're going to pay when you try to borrow moving forward. But another thing, right, that interest rate is obviously going to compound. And so I saw, one of the stats that said the average, so like about half of Americans are carrying a balance right now, but the average is about $6,200. So using that number, right, you got to ask yourself, okay, what's the minimum? A lot of people get caught in the cycle of just paying that minimum. Oh, I'm going to just keep paying the minimum. Guess what, people? The minimum is roughly 2% of what your outstanding balance is. So on that $6,200, I'll just round it to purely $6,200. The minimum at 2% is literally $124.
Yeah.
However, if you have an average interest rate on that credit card, that's roughly $124. So the reality is you would only be paying the interest rate and not the principal. So for instance, on that graphic that we just had, if it was actually to bump it up to maybe $130, you're paying $6 extra, well now that will actually get you to pay it off, but guess how long? 13 years, right? And now you're also paying a ton more in interest. I think you'd probably be paying over 5x what you borrowed. So it's a lot of ramifications when it comes to credit cards.
There's also been a new way, of course, and this has been revised, at least the way that the credit score is calculated in recent years, where people can now have other regular payments that they're making, say, for instance, on rent, on things that are even, I think I heard even down to your Netflix account, if you're paying on that can actually help your credit worthiness. How many people are tapping into things like that? Is it clear?
I'm not sure if the data there is clear, but I do understand that there are other ways that people are finding, ways to actually say, okay, how could I actually help this person when it comes to being more credit worthy? Because obviously some people don't have access, or other communities are traditionally underbanked, so they don't actually have, when it comes to, because credit mix is another thing that comes to your FICO score. So it's like, what are some other ways? And obviously everyone, for the most part, is paying their rent on time.
Yeah, we certainly hope so. Ross Mack, thanks so much for taking the time here, joining us this week in studio. Appreciate it.
My man.
Absolutely. Coming up, many Gen Z professionals are not about that traditional life. We'll dig into the statistics backing Gen Z's preference for freelance careers. Gen Z, I don't hate you. I just want you to know that. It's in the prompter. Our producers wrote it. I'm going to read it here today, but we're going to dive into it a little bit on the other side. But before we get into that, Nvidia reports quarterly results after the bell Wednesday. Here's a look back at the company's rise.
From creating graphics cards for gaming to becoming one of the world's leading AI chip companies, it's safe to say Nvidia is officially one of the tech giants. In 2023, the company generated nearly $27 billion in revenue, and its market value is well over $1 trillion. Let's take a closer look at what led to Nvidia's boom with Beyond the Ticker, where we dive into the company's biggest moments. Nvidia was founded on April 5th, 1993 by Jensen Huang, Chris Malachowski, and Curtis Priam, with a vision to bring 3D graphics to the gaming industry. In 1997, Nvidia launched its first hit product, the NV3. It would later go on to sell a whopping 1 million units in its first 4 months of availability. On January 22, 1999, Nvidia went public via IPO at $12 per share. And in 2000, Microsoft chose Nvidia to develop the graphics hardware for the first Xbox console. 5 years later, Microsoft's rival Sony chose Nvidia's hardware to power the PlayStation 3. In 2010, Nvidia became the graphics chip supplier for automaker Audi. And in 2015, the company launched its Nvidia Drive chip for powering driver assistance technologies. In 2016, Nvidia kicked off its AI efforts with the launch of the DGX-1. 2 years later, the company debuted Nvidia RTX, the first GPU capable of real-time ray tracing. That same year, Google announced it was using Nvidia's Tesla P4 graphics cards for its Google Cloud platform. In 2022, Nvidia debuted its H100 graphics chip for AI, which still stands as one of the world's most powerful chips for artificial intelligence apps. And in May 2023, Nvidia eclipsed the $1 trillion market cap mark, joining the ranks of mega companies like Apple and Microsoft. The stock continues to surpass its all-time highs over the past month and is currently trading at over $700 per share. From a company of 3 engineers working on graphics cards to thousands of employees working on chips that will power the AI supercomputers of the future, Nvidia remains at the top of the tech industry.
We've all read the headlines. Gen Z has a different view on work than their older counterparts. More than half of Gen Z professionals are choosing freelance careers over traditional jobs, the headlines say. And the majority of them are choosing freelance for flexibility. That's according to Upwork's latest survey. So, to break down what you need to know about the Gen Z workforce and, of course, to demystify the headlines from the actual data, we've got Kelly Monahan, who is the Upwork Research Institute Managing Director, here with us. Kelly, great to see you. Thanks so much for taking the time here on Wealth. First, where ultimately are some of the Gen Zers kind of flocking into the workforce based on this survey data?
Yeah, Brad, what we see within our survey data is that Gen Z is really redefining what it means to have a long-term career today. As you mentioned, our headline is, over 50% are choosing to work full-time in a freelance capacity. And I think a lot of that is driven by the macroeconomic conditions, that they need to make money and that they want stability. And they've seen a lot within the macro climate today that's caused, whether that's been layoffs, inflation. And so this need to be much more in control of their careers is what I'm seeing underneath the data set. And where are they working? It's in really highly skilled avenues. So 70% year over year growth we've had on our platform in the areas of AI and machine learning. And these Gen Z freelancers are much more likely to already have the AI certificate in their hand ready to go.
No doubt, Gen Z will have had its hands on technology for far longer, at least in a percentage of their life, than generations prior, purely because for much of the technological advancements, they've been there literally since they were born, really. And so all of these things considered, what do business leaders need to know about how to engage with Gen Z in the workplace and how to, of course, continue to make sure that they are, for lack of a better word, stimulated at work?
Yeah, so I think this is a big wake-up call for leaders today. The way that we've structured employment and work, I think through often the times you hear, and HR leaders in particular talk about it in terms of talent acquisition. Meaning I want to find that one person, that one unicorn who can come in, and I don't want them working or doing anything else, but working on this role or this job. Gen Z is telling us that's not how they want to work. And so what they're asking business leaders to think about is talent access over talent acquisition. And that means I want to come in, I want to work on projects that I find meaningful, that I'm learning and developing and growing my skill sets on. They're the most diverse generation to ever walk the planet as well. And so they're looking for cultures and environments where they can feel they can be themselves, which is why we found 63% of Gen Zers are freelancing because of that reason. They don't feel they can be themselves in corporate cultures today. So if I'm an executive, I got to really be rethinking through, how do I access this talent? How do I make sure I don't need to have control ultimately over them? And I'm much more open-minded. They're going to be working in an open talent ecosystem today.
How does the wages compare? I mean, we're talking about a generation that is really cozied up to the idea of having flexibility, setting their own schedule, knowing the type of projects that they want to work on, and being able to really thrive in a freelance-driven environment more than ever before, perhaps, versus some of the wages, some of the coverage, even in benefits and total compensation packages that it would be compared against if it was just a normal 9 to 5.
Yeah. So I think the great thing that we're seeing with Gen Zers in particular on our platform is that they're able to set their own rates. And so I know there's obviously a lot of conversations around the social safety nets, but what Gen Z has been able to do, especially those that have a post-grad degree, so we saw within our survey research too that 7% of Gen Zers who hold a post-grad degree are again choosing to freelance full-time instead of going to a corporate position. That's a really big flip than what I was expecting to see in the data, and I think what we've seen from other generations. So because of that, if you have Gen Z, if you've got the right skill set, especially those in the technical domain, and/or let's talk about enduring human skill sets too, those that can manage, communicate large complex projects, you actually might be able to earn more going through a freelancing route because you're able to set those wages and making sure that you're doing so in a way that covers your social safety nets.
Kelly, we only got 15 seconds left. And in a game, informal game of, so you think you want to freelance, what is the number one consideration that people need to keep in mind?
Number one thing is making sure that you're learning and reskilling. In order to freelance, you're in control of your career. Make sure you're staying on top of the trends and continuing to skill with what's in demand today.
Kelly, crushing it. Kelly Monahan, who is the Upwork Research Institute Managing Director. Thanks so much for the time.
Thanks, Brad.
Absolutely. Let's do a final check of the markets here as we're taking a look at the major averages. Oh no, slippage on aisle Nasdaq. We're flat, just barely to the downside. We'll see if we can hyper oscillate as we go on throughout the rest of the day and ultimately end back in positive territory. Fingers crossed. Dow, S&P 500, they're in the green, just barely by the hair of a chinny chin chin. That's it for wealth right now. I'm Brad Smith. Thanks so much for watching, and stay tuned for Market Domination with Julie Hyman and Josh Lipton. That's coming up 3 p.m. Eastern Time. You don't want to miss it.